are you?
Hello, how are you doing? Yeah. We have a quorum? The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of Prudential Regulators, Ensuring the Safety, Soundness, Diversity, and Accountability of Depository Institutions. I want to inform all concerned that this hearing will end at 1:30 p.m. or at the first series of votes on the House floor. I now recognize myself for 4 minutes to give an opening statement. Today, we're here to conduct oversight of regulators at the Federal Deposit Insurance Corporation, that is FDIC, and the Federal Reserve and the National Credit Union Association, as well as receiving written testimony from the Office of the Comptroller of the Currency. So I'd like to welcome back Chair McWilliams, Vice Chairman Quarles, and Chairman Hood. I'm very concerned that our banking regulators are following the dangerous deregulatory blueprint that the Trump administration laid out in a series of Treasury reports and checking off deregulatory items one by one. For example, they have moved to weaken capital, stress testing, and other requirements for the largest financial institutions, taken action to weaken the Volcker Rule, which prevents banks from gambling with taxpayer dollars, and propose weakening the swap margin rule, which would threaten our economic stability, for a $40 billion giveaway to Wall Street mega banks. In rolling back important reforms put in place in the Dodd-Frank Wall Street Reform and Consumer Protection Act to protect consumers, investors, and the economy. Regulators are opening the door to bad practices that contributed to the devastating financial crisis of 2008. I'm also very concerned that regulators are making a brazen attempt to weaken the implementation of the Community Reinvestment Act, that is CRA, under the guise of modernization. CRA is an important law that was passed in 1977 to prevent redlining and to ensure that banks are meeting the credit needs of the communities where they are chartered. While the implementation of the law needs updates to reflect the modern banking landscape, those changes should make the law more effective, not less. 98% of banks already receive a passing grade on their CRA exam, which shows that the law needs more teeth to get positive results for underserved communities. In the wake of regulators' approval of the SunTrust BB&T merger, which creates the 6th largest bank in the nation, I'd like to make it clear that this committee will continue to closely scrutinize large bank merger proposals. Regulators have a responsibility to ensure that bank mergers serve the public interest and do not create mega banks that threaten our economy and financial system. It is not acceptable for bank mergers with implications for communities across the country to receive a cursory review or a rubber stamp from bank regulators. This committee has been very focused on diversity and inclusion in the financial services sector, including through the committee's historic new Subcommittee on Diversity and Inclusion. Earlier this year, I and Congresswoman Beatty, who chairs the Subcommittee on Diversity and Inclusion, wrote to the mega banks and requested their diversity and inclusion data and policies. The information we received reinforces what we already know, that these banks badly need to improve their diversity and inclusion. For example, less than 1% of mega bank spending is devoted to diverse asset managers and suppliers. Since each of the agencies represented by our witnesses today has a dedicated Office of Minority and Women Inclusion, I expect to hear today about their diversity and inclusion efforts. I look forward to discussing these matters with our witnesses. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, thank you, Chairwoman, for holding this hearing today. It's a very important and necessary hearing, and good for our members to get this interaction with the regulators, and I appreciate you all being here. And so I want to thank Chairs Hood and McWilliams and Vice Chair Quarles for appearing before the committee today. And I want to thank each of you for taking the time, not just to testify, but for prioritizing the common sense reforms that are necessitated by the bipartisan law that we commonly refer to as S-2155. The last time you testified before the hearing in May, we called on you to take swift action on implementing this bill, and you've answered the call, largely. Clarifying the Volcker Rule and tailoring requirements for foreign banks are just a few examples of regulatory right-sizing that you've implemented to ensure our economy, small businesses, and consumers remain vibrant and strong. However, there's more work to be done. There's certainly more work to be done. And what we'd like to see from you is the pace up and continue to up so that we are staying ahead of market conditions and economic conditions. We need to make sure that the tools are there to help serve consumers and communities. I also want to take this opportunity to raise a number of concerns that I continue to have. I'm concerned with the trend in the Federal Reserve's open market operations in the wholesale funding markets. I appreciate Chairman Powell's prompt response to my recent questions about the Federal Reserve's repo market operations. And I understand there may be further interventions necessary at the end of the year. The Fed's intervention in the repo market raises the important question of how regulatory changes to our financial system are impacting its structure and function and impacting monetary policy. I think it's very important the Federal Reserve have its independent monetary policy standards. I think it's very important for the global economy, the American economy, and American consumers. But the regulatory changes, it's necessary for Congress to have oversight of those regulatory changes. And in this circumstance, if regulation is driving monetary policy, bad regulation is driving monetary policy, I think that raises greater concerns about financial stability in the market and also economic growth. So in addition, the combined impact of proposed capital requirements, including Basel III revisions and the stress capital buffer, could have a significant impact on required capital if not thoughtfully implemented. This may further exacerbate the underlying issues that we're seeing. So it's important to consider the system of capital requirements as a whole to ensure regulations are appropriately calibrated to allow institutions to continue to support economic growth. In addition, in May, I voiced my concerns with the transition from LIBOR to SOFR. 6 months later, I'm still concerned consumers will be impacted by this transition. The repo market intervention is just one example of why that is of concern and should be of concern to average everyday investors. As you know, LIBOR is the underlying bank reference rate for approximately $200 trillion in financial contracts worldwide, and is set to be phased out as a bank reference rate at the end of 2021, or by 2021, and replaced with SOFR. Given the volatility in the repo markets, I'm concerned about the consequences that volatility will have on mortgages, auto loans, business loans, and other consumer loans as a new reference rate if that's driving overnight financing. Transferring LIBOR-based legacy contracts to SOFR will also require financial institutions to renegotiate with consumers, customers, and exposed banks to litigation risk. I hear that clearly the tap, 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 and I will, with that, I will reserve the rest of my comments for my questions. But thank you for being here, and I appreciate your attendance.
I now recognize the chair of the Subcommittee on Consumer Protection and Financial Institutions, Mr. Meeks, for 1 minute.
Thank you, Chairwoman Waters. And I'm glad we have 3 of the Prudential Regulators before us today, but I'm very disappointed that Mr. Outing, Comptroller of the Currency, did not make himself available to testify today. One of the issues I've spent the most time on this year, including chairing subcommittee hearings, sending letters, and leading a tour of my district in Queens this past summer, is the modernization of the Community Reinvestment Act. It appears that the OCC has abandoned the joint agency process and will plow forward with its approach to CRA modernization with a simple metric to evaluate bank lending to formerly redline communities. This approach is likely to decouple the link between CRA and the very communities it was created to serve, and discrimination against whom it was meant to bring redress. I look forward to engaging with the witnesses here today on this and other issues, particularly dealing with non-bank lenders and small dollar loans and broker deposits, and I look forward to engaging with the witnesses shortly. I yield back the balance of my time.
Thank you. I now recognize the subcommittee's ranking member, Mr. Lukemeyer, for 1 minute.
Thank you, Madam Chair. I'd also like to thank the panel for testifying today. I look forward to discussing multiple issues with you regarding our financial system. I would like to begin by reiterating my concern over FASB's current expected credit loss accounting standard, called CECL. Time and time again in hearings before this committee, it has been stated that CECL will have a detrimental effect on small financial institutions and specifically low to moderate income and minority consumers. Despite the numerous testimonies, hearings, statements, and letters highlighting these issues, this committee has remained silent. No one, or not one, hearing examining CECL and no congressional oversight on any accounting standard that will prevent Americans from achieving the American dream of home ownership. While I'll discuss issues with the panel today besides CECL, I'm hopeful some of our witnesses who will be charged with enforcing the standard will outline how they plan to protect consumers in the absence of committee action. With that, I yield back the balance of my time.
Thank you. I want to welcome today's distinguished panel, the Honorable Rodney Hood, Chairman, National Credit Union Administration, the Honorable Jelena McWilliams, the Chair of the Federal Deposit Insurance Corporation, and the Honorable Randal Quarles, Vice Chair of the Supervision Board of Governors of the Federal Reserve System. I note that the Comptroller of the Currency, Joseph M. Otting, was invited to testify at today's hearing, but was unable to appear. I intend to have him appear as soon as possible before this committee, and he may be a single panel, but it is important, Mr. Meeks, that we hear from him. I understand he has submitted some written testimony, but that does not really substitute for his appearance here today. Without objection, all of the witnesses' written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. When you have 1 minute remaining, a yellow light will appear. At that time, I would ask you to wrap up your testimony so we can be respectful of both the witnesses and the committee members' time. Chairman Hood, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, good morning. As the 11th chairman of the National Credit Union Administration Board, I am honored to testify before you this morning. In my brief opening statement, I will be discussing 3 topics. First and foremost, the state of America's credit union system. Secondly, I'll talk about NCUA efforts to foster diversity and inclusion. And third, I'll discuss cybersecurity. First and foremost, I'd like to note that strong growth trends in federally insured credit unions are continuing in 2019. Roughly 119 members are a part of the credit union system. That represents roughly 1/3 of the American public. Credit union assets through third quarter approximate $1.54 trillion. Credit unions also have a really strong net worth at the moment, an 11.39% aggregate net worth, well above the 7% statutory requirement. The National Credit Union Insurance Share Fund also remains well-funded at $16.7 billion, which should be noted that that is a sizable increase from where it was approximately at $10 billion 10 years ago. Year-to-date operating results evidence that the credit union system is solid and healthy. I'd now like to focus my attention in discussing NCUA efforts to foster diversity and inclusion. I firmly believe that financial inclusion is the civil rights issue of our time. However, inclusion means not only broader access to financial services, but also employment and business opportunities. NCUA takes its responsibilities seriously in implementing the Dodd-Frank Section 342. When I travel around the country, I mention the importance of filling out the diversity survey. I also work with our head of OMWE, Monica Davey, to ensure that we are reaching out to diverse minority businesses. To that end, I'm pleased to report that NCUA supplier diversity spend is 44.5% to date. In addition, NCUA just hosted its first ever Diversity, Equity, and Inclusion Summit. This summit took place just a few weeks ago, and it really demonstrated the importance of diversity and inclusion being more than a check-the-box exercise. Rather, our Diversity, Equity, and Inclusion Summit demonstrated that this should be viewed as a business and strategic imperative if credit unions are going to respond nimbly to shifting demands and demographics and to respond to today's dynamic marketplace. Given the well-attended DEI event, I am intending now to host the DEI Summit across the United States. So we're going to make this a yearly event, and I, to the degree possible, would like to invite you all in House Financial Services to join us when we host these summits in your areas. MDIs, Minority Depository Institutions, they are the lifeline in providing affordable financial services in communities of color. NCUA provides capacity-building activities to help these institutions reach and serve their mission. Capacity-building activities at NCUA include ongoing education, technical assistance, and our newly launched mentoring program. I will in turn be hosting an MDI Summit in early 2020 so that these institutions can continue to get the necessary support they need to bring affordable financial services to communities of color. I'm very pleased to report that the NCUA board is also supporting diversity and inclusion. We just recently, as a board, developed a short-term low-dollar product to provide opportunities for people needing emergency loans. We're calling it the PALS 2 program, and it is a responsible alternative loan product for people so that they will no longer need to go to pernicious payday lenders to get their needs met. We also, as an NCUA board, have approved the Second Chance Initiative. The Second Chance Initiative works with individuals who've had nonviolent criminal offenses in the past, who have paid their debt to society, where now these individuals can work with federally insured credit unions so they can have greater opportunities for career success and also have opportunities for upward mobility and access to shared prosperity. The third area I'd like to talk about is cybersecurity. Cybersecurity is a high priority for me as chairman. Cyber attacks are acute, and we are making sure that we leverage our resources to provide credit unions with the support they need to combat these challenges. In closing, I would like to go back to my statement again of financial inclusion being the civil rights issue of our time. I, ladies and gentlemen of the committee, would like to work in partnership with House Financial Services to look for legislative solutions to help credit unions adopt underserved areas. Thank you.
Chair McWilliams, you are now recognized for 5 minutes to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, members of the committee and staff, thank you for the opportunity to testify today. Exactly 18 months ago, I began serving as the 21st chairman of the FDIC, and I'm happy to celebrate my half birthday with all of you here today. During this period, the FDIC has undertaken a great amount of work with a particular emphasis on 3 overarching goals. 1, strengthening the banking system as it continues to evolve. 2, ensuring that FDIC insured and supervised institutions can meet the needs of consumers and businesses. And 3, fostering technology solutions and encouraging innovation at community banks and the FDIC. The FDIC has made significant progress in each of these areas, and I appreciate the opportunity to share our progress with this committee. Before discussing the FDIC's work to strengthen the banking system, I would like to begin by providing context regarding the current state of the industry. The U.S. banking industry has enjoyed an extended period of positive economic growth. In July, this expansion became the longest on record in the United States. By nearly every metric, the banking industry is strong and well-positioned to continue supporting the United States economy. While the state of the banking industry remains strong, the FDIC is continuing to monitor changes in the industry and work to further strengthen the banking system by modernizing our approach to supervision, including outdated regulations and increasing transparency, enhancing resolution preparedness, assessing new and emerging risks, and creating the workforce of the future. My written statement details the many actions the FDIC has taken in each of these areas. While these efforts are steps towards a stronger banking system, there are certain areas in which the needs of consumers and businesses must be addressed by more comprehensive reforms. We have been working diligently to update our regulations governing broker deposits, which were put in place over 30 years ago. In addition, we're working with our fellow regulators to modernize the Community Reinvestment Act and provide clarity for banks seeking to offer loans that meet consumer small dollar credit needs. Finally, perhaps no issue is more important or more central to the future of banking than innovation. Technology is transforming the business of banking, both in the way consumers interact with their banks and the way banks do business. Regulators cannot play catch-up, but must be proactive in engaging with stakeholders, including banks, consumer groups, trade associations, and technology companies to understand and help foster the safe adoption of technology across the banking system, especially at community banks. Since 1933, the FDIC has played a vital role in maintaining stability and public confidence in the nation's financial system. This mission remains as critical today as it was 86 years ago. But if we are to achieve our mission in a modern financial environment, the agencies cannot be stagnant. Last year, I began a 50-state listening tour to engage with state regulators, FDIC-regulated institutions, consumers, and other stakeholders. At the outset of that effort, I emphasized the need to reverse the trend of having those affected by our regulations come to Washington to have their voices heard, but instead to meet them on their home turf. With 26 state visits, I'm now more than halfway through the listening tour, which has been incredibly informative and has underscored the importance of seeking perspectives outside of the Washington Beltway. I look forward to visiting the remaining states and learning more about the issues that matter most to consumers and communities across the nation, including your constituents. Thank you again for the opportunity to testify, and I look forward to your questions.
Thank you. Vice Chairman Quarles, you are now recognized for 5 minutes to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, members of the committee, thank you for the opportunity to appear today. My colleagues and I join you on the cusp of a significant and shared milestone, the full and faithful implementation of Congress's efforts to improve financial regulation in the form of the Economic Growth, Regulatory Relief, and Consumer Protection Act. Today, I'll briefly review the steps we've taken toward this milestone, share information on the state of the banking system, and discuss the continuing need to ensure our regulatory framework is both coherent and effective. The Act was an effort to consolidate a decade of work on financial reform and a specific targeted response to the conditions facing today's banking organizations and their customers. It was also rooted, however, in a long-standing congressional practice of reviewing the work done in the immediate aftermath of a crisis, of addressing any gaps, and of ensuring that public and private resources go toward their best and most efficient use. The board's latest Supervision and Regulation report, delivered in connection with my testimony today, confirms that we have a stable, healthy, and resilient banking sector with robust capital and liquidity positions, stable loan performance and strong loan growth, steady improvements in safety and soundness, and several areas of continued supervisory focus, including operational resiliency and cyber-related risks. The banking system is substantially better prepared to manage unexpected shocks today than it was before the financial crisis. And now, when the waters are relatively calm, is the right time to examine the efficiency and effectiveness of our protection against future storms. With last year's reform legislation, Congress made a significant down payment on that task, and in less than 18 months after the Act's passage, we have implemented all of its major provisions. Earlier this year, we completed a cornerstone of the legislation, tailoring our rules for regional banks and building on our existing work that firms with greater risks should meet higher standards and receive more scrutiny. We previously relied heavily on a firm's total assets as a proxy for these risks and for the costs that the financial system would incur if a firm failed, and that simple asset proxy was clear and critical. It was rough and ready, but it was neither risk-sensitive nor complete. Our new rules employ a broader set of indicators to assess the need for greater supervisory scrutiny and maintain the most stringent requirements and strictest oversight for the largest and most complex firms. We and our interagency colleagues have also worked on a range of measures addressed to smaller banks, with particular attention to the community bank business model. And our goal through this intense period of regulatory activity has been to faithfully implement Congress's instructions. But those instructions also speak to a broader need and one central to our ongoing work, which is to ensure that our regulatory regime is not only simple, efficient, and transparent, but also coherent and effective. Financial regulation, like any area of policy, is a product of history. Each component dates from a particular time and place, and it was designed, debated, and enacted to address a particular set of needs. No rule can be truly evergreen. Gaps and areas for improvement will always reveal themselves over time. Our responsibility is to address those gaps without creating new ones, to understand fully the interaction among regulations, to reduce complexity where possible, and to ensure our entire rulebook supports the safety, stability, and strength of the financial system. My colleagues and I are paying particular attention to coherence in our capital regime and in the full set of post-crisis reforms, to a smooth transition away from LIBOR and other legacy benchmark rates, to sensible treatment of new financial products and technologies, and to clear, consistent supervisory communication, which reflects and reinforces our regulations and laws. My written testimony and the accompanying supervision and regulation report cover each of these areas in greater detail, and again, I appreciate the opportunity to discuss them with you today. Thank you, and I look forward to answering your questions.
Thank you. I now recognize myself for 5 minutes for questions. Earlier this year, my colleague, Representative Meeks, held a subcommittee hearing focused on the Community Reinvestment Act. We heard expert testimony demonstrating that more than 40 years after the passage of the CRA, 98% of banks consistently pass their CRA exams, while at the same time, we have redlining in more than 60 metro areas across the country. There is something out of sync. Instead of working together to make CRA exams more stringent and taking steps to ensure banks fairly serve all communities, we have at least the OCC, if not also the FDIC, in a rush to get a rulemaking out this year in a brazen attempt to weaken the CRA with or without the Federal Reserve. As we have seen in the growing list of deregulatory actions in recent months by these agencies, I'm concerned that this new CRA proposal will simply make life easier for banks that have been making record profits. So, Chair McAdams, Comptroller Auditing at the OCC, who unfortunately was unable to testify today in person, seems to be in a rush to get a proposed regulation out the door this year. And it appears the Federal Reserve does not agree with this proposal. Instead of signing on to the OCC's plan, as he said or indicated, and instead of signing on to the OCC's plan, would it not be helpful to encourage Mr. Auditing to take more time to work with the Federal Reserve and see if there is a mutually agreeable path forward? If we have two different CRA regulations, will that not lead to regulatory arbitrage and inconsistent application of the law? This was in his testimony, that is Mr. Auditing's testimony. He said the OCC is working with our colleagues at the FDIC to issue it jointly. A joint rule with the FDIC would cover all national banks, state banks that are not members of the Federal Reserve System, and federal state savings associations. So you're here today to speak for yourself. Is this what you're doing?
I'm sorry, the question?
Yes.
Yes. We are engaged in interagency negotiations on how to best modernize and improve the CRA.
Are you working with Mr. Auditing and the OCC to issue a joint proposal?
We have been working with both the Federal Reserve and the OCC on...
The Federal Reserve does not agree with you. How do you plan on resolving that?
I don't know how to resolve the Federal Reserve not agreeing with us. It wouldn't be the first time that the Federal Reserve and the FDIC have a difference in opinion on a particular matter. But I do know that there's an opportunity. Since 1995, this act has not been revised. And there's an opportunity to do more for minority depository institutions. There's an opportunity to do more for small farms.
Would you describe that opportunity to do more for minority institutions? How does that work?
Correct, and it's a great question, and thank you for that. Right now, the minority depository institutions can qualify for CRA, the non-minority depository institutions can qualify for CRA credit if they engage with a minority depository institution. Right now, the definition of how that partnership can be structured is more narrowly interpreted for the purposes of the CRA, and I believe there's an opportunity for us to expand what qualifies and what types of investments and community development activities with MDIs would qualify for CRA credit. There's also more to be done on small farms. There's a whole lot more we can do on CRA for small businesses, for Indian country, and a number of different entities that, frankly, the CRA could be doing more for.
Do you think it is important to work with this committee on such a huge change dealing with the CRA that's extremely important to so many communities? It seems as if you and Mr. Otting have just made a decision, despite the Federal Reserve and without any interaction with the committee. Why do you want to work in that way without trying to get in tune with all of the entities that are involved with trying to make a decision of this magnitude?
Chairwoman Waters, I have nothing but the utmost respect for this committee, and I look forward to working with you on any issues that are important to your constituencies. And as a former congressional staffer, I certainly would pay a lot of deference to your opinions and input on matters that are important.
You have not demonstrated that to date. I appreciate your indicating that here at this hearing today. We're very concerned about this, and we're not accepting of any proposal that is being put together by you and Mr. Otting that undermines the original mission of the CRA. With that,
If I may just
I will
add
move.
something.
Thank you very much. The gentleman from North Carolina, Ranking Member Mr. McHenry, is recognized for 5 minutes.
So to that extent, Ms. McWilliams, Chair McWilliams, safety and soundness is a primary obligation you have. Economic growth, safety and soundness. But when you're inhibiting economic growth through old regulations on the books, that's bad, right? But when you're also impacting financial stability by not reviewing regulations, that's even worse, and I think that's malpractice. So I would encourage you to review these old regulations and take reasonable steps to ensure that we have financial stability on a going forward basis. Vice Chair Quarles, so in September, there was a tremendous volatility in the repo market. This is overnight lending. It's a very technical aspect for most Americans, but it is of concern to us as policymakers. Rates moved well beyond the Fed's targeted rate, which prompted the Fed to intervene in a pretty significant way and for a significant amount of time pledged going forward. So given that, if you could comment on what policies might have contributed to the shortage of cash in the repo market.
So thank you. That is, as you've noted, there were a complex set of factors that contributed to those events in September. Not all of them were related to our regulatory framework, but I do think that as we have considered what were the driving factors in the disruptions in the repo market in September, we have identified some areas where our existing supervision of the regulatory framework, less the calibration or structure of the framework itself, may have created some incentives that were contributors. They were probably not the decisive contributors, but they were contributors, and I think we need to examine them. Particularly among them are the internal liquidity stress tests that we run that create a preference, or can create a preference at some institutions for central bank reserves over other liquid assets, including Treasury securities, for the satisfaction of their liquidity requirements under the liquidity framework that's put in post the crisis.
And that would be considered an unintended consequence of regulation rather than intended consequence, would it not?
The regulation was intended to be structured so that banks would be indifferent between central bank reserves and other forms of liquid assets, particularly Treasury securities, in satisfying their high-quality liquid asset retention requirements, and the liquidity coverage ratio itself does not make any distinction.
But in practice, it appears that there is a distinction.
Some banks, from their internal assessment of how their liquid assets will perform in a future period of stress, have put a heavy emphasis on central bank reserves as the most liquid assets. Treasury securities take a day to settle. Markets can be disrupted in the event of extreme unexpected events. So that does create a thumb on the scale for central bank reserves. So I think that it is worth reviewing, and we are reviewing some of these supervisory measures.
So I would encourage
how
you
much they
to
contribute.
review the regulatory and supervisory issues. And I think it's important for Congress to also hear back on that review. We understand the independence of monetary policy, but where regulatory policy is impairing or impacting monetary policy, I think we need to make sure that we're doing the right thing with these regulations.
Completely agree.
But want to pivot as briefly as we can to the conversion from LIBOR to SOFR. And this change, the repo market issues in September highlight the deficiencies of this new SOFR standard. You've commented publicly, Mr. Quarles, on some challenges related to that. And I think it would be important for Congress to hear back on the financial stability challenges and the intention of the Federal Reserve to ensure that this new rate doesn't cause greater stress on the financial system or unnecessarily create financial instability. And so I would encourage that undertaking by the Fed, but also I know it impacts the FDIC and the NCUA as well. So with that, I yield back.
The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Shortly after you all testified in May, Daniel Torello, the Federal Reserve governor who spent 8 years following the crisis rewriting the Wall Street rulebook, denounced what he reviewed as the Trump era's low-intensity deregulation of the financial services industry. He described it as a large number of small tweaks to existing regulations that individually gather little notice by the press, but taken together will undermine the regulatory framework designed to prevent another crisis. He said somewhere down the line, someone else will suffer the damage, and in likelihood, it will be the most vulnerable households and businesses. Vice Chair Quarles, how do you respond to former Governor Torello's comments? Do you have a concern that easing the Volcker rule and dialing back on swap margin requirements and reducing the leverage ratio for megabanks will not push the system a little closer to a crisis?
So as we have looked at the recalibration of some of the post-crisis reform rulebook in order to ensure that we are not creating sort of perverse regulatory incentives and avoiding unintended consequences, it would be very surprising if there weren't some of those in such a complex body of post-crisis regulation. One of our principles has been to ensure that we do not reduce in any material way the loss-absorbing cushion of the institutions, and I think we have succeeded in doing that. Statements like that there's a low-intensity deregulation, I think have to be held to empirical account, and we have maintained the quantitative resiliency of the industry, and the changes that we've made, I think, actually improve the safety and soundness of the industry because they eliminate perverse regulatory incentives.
Obviously, your predecessor, Federal Reserve Governor, disagrees, but I want to go on. Resolution plans have been a valuable tool for improving resolvability through bankruptcy. Living wills have helped large banks be better organized, but now the FDIC seems to be dialing back those requirements. Why should mega banks like Wells Fargo only have to update their complete living will only 4 years?
Thank you for that question, Congressman. The living will process has evolved since its inception and Title II, in the enactment of Title II of Dodd-Frank. For a couple of cycles, we have received submissions that have been in the tens of thousands of pages. And we now have enough information where we can hone in and zoom in on the things that we actually think are more essential to resolving a bank and better to our understanding of how that bank would be resolved. Frankly, what we're trying to avoid is having these banks just update the 20,000-page submissions every few years and not really look at some of the essential issues that are underlying. So I have tasked staff with identifying the critical areas that we need to do a deeper dive on and focusing on those areas in particular.
I would think that things change over years, and you might want to require updating more currently. The criteria for individuals seeking employment in the banking and financial services industry with minor criminal offenses are under review. First, Mr. Hood, what are you doing, and what could Congress do?
Well, yes, sir. Thank you for that question. We at NCUA recently put forth a final rule regarding the Second Chance Act, where we recognize that individuals who've committed nonviolent criminal offenses, who've paid their debts to society, should have opportunities to work in federally insured credit unions. We look forward, sir, to partnering with you to see if opportunities that can continue to remove barriers.
Ms. McWilliams?
I believe that the policy you're discussing, we're calling it our Section 19 policy, the FDIC, is an important social justice issue, and we are currently undertaking an effort to both publicly seek comments on what more the agency can do. We have made some revisions, but I personally believe we can go a long way in enabling these individuals to re-enter the workforce and also allowing more prosperity in the economy by allowing them the opportunity to have a job.
I'll ask you to focus on that, and I'll yield back.
Thank you.
The gentlewoman from Missouri, Ms. Wagner, is recognized for 5 minutes.
Thank you, Madam Chairwoman. Vice Chairman Quarles, thank you for joining us today, all of you for joining us today. And in September of 2019, you delivered a speech in which you reiterated the Fed's plans to finalize the stress capital buffer proposal in time for the 2020 Comprehensive Capital Analysis and Review, or CCAR, which means the rule would need to be proposed in the very, very near term. The goal of the stress capital buffer is to provide clarity and harmonization to the overall capital framework for financial institutions that are subject to stress tests. Vice Chairman Quarles, is it still the Federal Reserve Board's intention to have the stress capital buffer finalized in time for the 2020 CCAR?
We are still aiming to have that done in time for this stress testing cycle. You're absolutely right, that time is short.
Given that a reproposal would need at least 60-day comment period, the CCAR instructions are typically issued in January. It seems like it would be very difficult to have that finalized. This proposal was originally released in April of 2018. So what is the reason for the significant delay in moving forward?
Well, the proposal raises a number of complex issues. I think the most significant one is one that I have talked about publicly, which is that we, and which was part of an answer to a previous question, which is that we do want to maintain the quantitative aggregate level of loss absorbency in the system to be the same, notwithstanding some of the incentive changes, some of the, I think, unwarranted assumptions and practices in the current stress testing regime. And calibrating and creating the methodology for keeping that aggregate capital level the same while addressing these incentives has proved to be complex. You're absolutely right that the time is short, but it is not impossible for us to get this done.
When can we expect a reproposal of the stress capital buffer?
We have not decided yet whether we would repropose or proceed in a different administrative procedure fashion.
I've asked you this question before, along with many of my colleagues, but given that the stress capital buffer will preserve the GSIB's surcharge, when does the board plan to update the rule as it explicitly said it would in 2015?
So we're always looking at all of the elements of the current regulatory framework to determine when a particular calibration might be out of whack. We regularly look at the calibration of the GSIB surcharge, and we are considering it in the context of the overall body of regulation. In particular, As you know, there is the remainder of the International Basel III agreement, the so-called Basel III Endgame, or the banks sometimes call it Basel IV, that remains to be implemented. I think that we should look at all of this as a package. The implementation of that remainder of Basel III could have the effect of significantly raising the aggregate level of capital in the industry. Both I and Chairman Powell have said that we think that that aggregate level of loss absorbency should remain is pretty much proper where it is. And so as we consider that implementation, I think we also then need to consider the overall calibration of
You told us, Vice Chairman, and pardon me for interrupting, but it explicitly said that in 2015, that you were going to update the rule. When can we expect this? I mean, given the many post-crisis reforms that have been implemented, is now not the logical time to recalibrate the surcharge to reflect economic growth and reforms?
So I think I think we should not be considering these issues piecemeal. That's one of the reasons why we are where we are, in my view. We have the opportunity and I think the responsibility to look at the remaining implementation of this Basel III Endgame as a package, and we would look at that as a package with the calibration of other existing elements of the regulatory framework, which would include the GSIB surcharge. But we should look at that as a package, and that's a project that we're actively underway on.
Well, I truly hope that you move expeditiously. The CCAR is up in January of 2020. You've been talking about this for years. Package, piecemeal. We need these rules updated, and I thank you, and I yield back.
The gentleman from New York, Mr. Meeks, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is recognized for 5 minutes.
Thank you, Madam Chair. Ms. McWilliams, I want to pick up briefly where the chairwoman left off because I'm very concerned about recent reports, and I want to find out if it's clear. So, have the FDIC signed on to the OCC's led CRA process and not doing it in an interagency process? Have you signed on to that?
The FDIC board needs to vote on any proposals before it, and that board vote has not taken place. So if you ask, have you formally signed on, the board has not voted on this yet, but we're actively.
But it's likely that you will do that.
It's likely that we will present an opportunity for the board to vote on the improvements to the CRA.
So just based upon the OCC, without the interagency process. So that means that you agree with, which I don't understand, the OCC's single ratio approach as the right way to go with regards to CRA, even though that risk breaking the direct link between bank lending and the specific community that the CRA was intended to benefit? I mean, is that so have y'all gone down that path already?
No, that is incorrect. There's no single ratio, single metric approach. I'm not sure where that information was derived from. The draft that I have seen that we've been working on does not include a single metric.
Some of it's come from my conversations with the OCC.
I would have to defer to OCC on those conversations.
But if you're joining on to them, then therefore I just want to make sure that you're engaged in more. And that's why the interagency process is tremendously important, so that it is more than just one idea, multiple ideas on how we can make sure that we're moving forward with the modernization of CRA so that we're not leaving out the original intent of the CRA that was put forward. So I just would urge the FDIC to re-look at how you're doing this and to make sure that you're working with the Fed also so that as we come to a modernized CRA, we make sure that we're not undoing the reason why the CRA was initially implemented. Let me move up because I want to ask you another question, Ms. McWilliams, on brokered deposits. As you may know, I'm working on legislation now to address what I consider antiquated rules which fail to account for the 30 years of technology innovation and new organizational structures that we can reasonably agree pose no systemic risk to the banking sector. Which elements do you expect the FDIC to address in its rulemaking, and which ones do you believe Congress needs to address through legislative action?
Thank you for that question. If I may just for a second go back to the CRA, I would not sign on to a proposal that basically in any way undermines the original intent of the law. And the proposal that I could sign on is a proposal that would actually yield more benefits for the communities that it was intended to protect. So you have my assurance that I would not sign on to anything that does not profess to do so. On the broker deposits, like you, I agree that it's an antiquated law. We have not touched at the FDIC the broker deposits in about 30 years. I believe there are some things that Congress could do as we're undertaking a review of the existing regulations and the practices in the marketplace and how technology has changed the way consumers do banking and banks do banking, frankly. I think there is an opportunity for us to work together on improvements. We will try to do what we can on the regulatory side, and to the extent that I have any recommendations to Congress, I would like to take you up on your offer and give you those as well. Thank you.
Thank you for that. Mr. Quarles, Mr. Chair, let me ask you quickly. The Fed published information that over half of the supervisory findings issued in the past 5 years were related to governance and risk management control issues. In 2017, I submitted a letter in response to the Fed's request for comment on its proposed guidance of supervisory expectation of board directors, advocating for the importance of picking diverse nominees when picking board directors. Now, when I looked at the Fed's guidance, it speaks of diverse experience, but it says nothing about diversity of board members themselves. So my question to you is, what are you going to do to deal with the urgent issues of making sure that there are diversity in the board members themselves?
Well, I think that's the intention of referring to diversity of experience, that as a board and as a corporation, as the firm considers the composition of its board, it will look to all the attributes of the board members to ensure that they have that relevant diversity. That is the purpose of that guidance.
Well, it just seems to me the language is clear. It says board, diverse experiences, not talking about the diversity itself of the board members. So someone could come in and say, well, I have that experience because I worked in it, but they're not diverse individuals. So my concern is to make sure that we have diverse individuals on those boards.
Thank you. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Madam Chair. Firstly, I would like to thank all of you for your leadership in promoting transparency and efficiency in supervising and regulating our financial institutions. This panel has implemented the major provisions of the Economic Growth, Regulatory Relief, and Consumer Protection Act, and I believe the resiliency of our financial system is now greater than ever before. Vice Chair Quarles, Chairman McWilliams, we have discussed at length on various occasions inter-affiliate margin requirements, and I'm pleased to see your agencies have recently proposed to amend these swap margin requirements. Thank you. The recent rule to exempt inter-affiliate swaps from initial margin requirements is an important step forward in identifying which areas can be simplified, harmonized, and streamlined to eliminate inconsistencies and overlap. And I look forward to continuing our discussion as you develop a final rule that will harmonize the treatment of margin requirements. We have also discussed the commercial end-user concerns with SACR. Again, I'm pleased to see your agencies revise the rule to amend the capital requirements for derivative contracts with commercial end users. You all know the nature of my district. It's capital intensive, it's agriculture, it's energy. So the actions of the Federal Reserve and FDIC have a tremendous impact back home on my constituents. Now, in light of the SACR rule, what are the agency's plans for moving forward with the implementation of Basel III? How does the Federal Reserve and FDIC plan to analyze the impact of those revisions across the U.S. framework to ensure coherence and capital neutrality?
Oh, please go ahead.
True lady.
I'll start with that one. Well, as I indicated, I do think that there are a few principles that we will need to keep in mind as we consider the implementation of the remainder of Basel III. And those principles are that we will maintain the current level of loss absorbency with the industry. We don't believe that the aggregate level of loss absorbency needs to be increased or that it needs to be decreased. And in order to do that, we should look at this implementation as a package. We should consider how the remaining elements work together, how they will work together with the already enacted elements, and while I think that each of them is a useful addition to the overall regulatory framework because of the incentives that they will create for particular actions, we also need to ensure that they are maintaining capital level, as you say, that they're essentially capital neutral. I think that we'll be able to do that by looking at everything as a whole rather than implementing them piecemeal.
If I may add, I do think that with the efforts at Basel, I think we need to take a holistic and comprehensive look at everything and not address the rulemakings piecemeal. And I agree with Vice Chairman Quarles on that. I also think that the Basel Committee can do a little bit more on analyzing the impact of these rules. There are so-called quantitative impact studies, QISs, that the Basel Committee can do, and it's something that the U.S. delegation at the Basel Committee has been insisting on for some time. I can tell you this, when the Basel III rules were promulgated on capital and liquidity, the initial rules, the Basel Committee did do a QIS study, and that study, if I recall correctly, the numbers may evade me, the correct numbers, but was done based on the balance sheets of banks on December 31st, 2009, which was one of the worst times for their balance sheets, and it took into account about 228 financial institutions around the world, only 14 of which were U.S. banks. And if I were in this position where I do have representation on the Basel Committee and the working groups, I would have insisted on a more specific impact at home here in the United States, and analysis done by the regulatory agencies on how these rules will impact our banks, and not look at 14 out of 228 banks on one of the worst days for their balance sheets in the history.
In a previous hearing, I raised an issue with Chairman Powell that we've been watching here in the committee for quite some time, and that's the implementation of the VOCA rule. And I laud the panel for taking on the task of trying to improve the rule. I suspect my colleagues will raise this issue as well, of course. Chairman Powell indicated at that time he does not consider long-term investments to be an activity that causes safety and soundness concerns. Now, Chairman Quarles, you know, Vice Chairman Chair Quarles, you know I have a tendency to ask things that are semi-reasonable and rational. So with that, yes, that's actually true. Can you commit to us that you will take into consideration how important it is for banks to make these long-term investments while you're working to finalize this portion of the rule?
We will definitely take that into consideration.
See, it was reasonable. Yield back.
The gentleman from Missouri, Mr. Clay, who is also the chair for the Subcommittee on Housing, Community Development, and Insurance, is recognized for 5 minutes.
Thank you, Madam Chair. And last month, the FDIC and OCC issued a proposed rulemaking to clarify that when a loan that is non-usurious, when originated by a bank, it remains non-usurious if the loan is sold, assigned, or otherwise transferred to a non-bank. In 2015, the Second Circuit held in Madden versus Midland funding that non-bank debt collectors that had purchased debt originated by a national bank could not benefit from the bank's exportation power. The OCC stated that the proposal is intended to address confusion resulting from the Madden decision. Consumer groups and legal experts have raised serious concerns that the proposal will encourage predatory rent-a-bank schemes that are designed to evade state usury caps. Chairman McWilliams, what is the FDIC's intentions with this proposed regulation? Is it intended in any way to administratively override the Second Circuit decision in the Madden case?
In fact, it is meant to clarify the confusion that has been caused by the Madden decision. Since 1828, there has been Supreme Court precedent that when a loan, if a loan is not usurious, at the time when the loan is made, nothing subsequently makes that loan usurious. And long-standing court precedent in 1865, Congress, this body gave national banks the ability to adopt those principles. In 1980, Congress gave the FDIC the ability to approve the same principles for state chartered banks. And everything was going fine, frankly. We have had an existing guidance in place for over 20 years on this issue until the Second Circuit Court of Appeals in Madden decided to just ignore the longstanding procedural and case precedent and regulatory precedent in this area. And we would not have had to act at all, frankly, if it were not for the decision in Madden. Once the decision in Madden was what it is, we felt there was a necessity to re-uphold the longstanding principles we have had and to reissue our statement that has been in existence for over 20 years.
Okay, so would your proposed regulation, would it effectively rent out these banks' charter to third parties hoping to evade state usury limits?
No, in fact, the FDIC, and we have stated this explicitly as well as implicitly, we look unfavorably upon such arrangements, and in the cases where there are such arrangements, we will take supervisory action that's appropriate if any state or federal laws are being violated.
So you will supervise the third party then and make sure that there's not an overcharging or...
We have a couple of different statutory authorities that allow us to supervise third parties that do business with banks or end up affiliating with banks in any form.
I see. And in November of 2019, the FDIC issued a proposal seeking public comment to codify a statement of policy related to Section 19 of the Federal Deposit Insurance Act, which provides criteria for individuals seeking employment in the banking industry with certain minor criminal offenses. In addition, the NCUA board approved a final interpretive ruling and policy statement allowing people convicted of certain minor offenses to return to work in the credit union industry without applying for the board's approval. Chairman Hood and Chairman McWilliams, what steps can Congress take to give ex-offenders who have minor offenses a second chance and get a job in the credit union industry? Mr. Hood first.
Well, first and foremost, this is an issue that I've taken quite seriously since I became chairman of the NCUA board. I think it's possible for us to sit down and perhaps discuss what have been. I'm sorry, I'm fighting a cold.
I do too, but go ahead.
I would love to sit down with your staff and maybe have some of our colleagues to discuss what have been some of the barriers that continue to prevent these individuals from seeking gainful employment. But we as a board are doing our level best to at least create opportunities now for these individuals who have paid their debts to society to get meaningful employment so they can get access to financial inclusion and have upward mobility. But we do look forward to following you and your staff.
I look forward to that conversation. To Ms. McWilliams, real quick.
Oh, sure, and I'll be very quick. Thank you. As I mentioned, from my personal perspective, it's a social justice issue that we need to be focused on. I have heard from civil rights groups, from community groups and community activists, and we're soliciting comment on what more we can do, and should we have any recommendations for Congress, I would be more than happy to engage with you.
Thank you. My time is up.
The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Quarles, CECL is something the Fed will have to enforce, as you well know. You and I have spoken and with other members as well about this, what I regard as a terrible accounting standard. However, you've remained on the sidelines as FASB is promulgated and eventually will implement this standard. This morning you've talked a number of times about different new capital rules and how you're going to be implementing them and looking at them. You made the statement a number of times how you believe the aggregate capital that is in the system today, as well as reserves, is adequate is at an adequate level. Now, when you implement CECL, there's going to have to be some additional reserves for most banks to be put in place. How do you do the Fed's two-step on trying to make sure that you continue to enhance the ability to be able to increase capital, yet not over-reserve as you indicate this may happen?
So the effect that you describe is one that we're very sensitive towards. There have been a lot of ex-ante assessments of the potential size of that effect. That's the reason why the bank regulatory agencies together have said that we would essentially phase in the the effect of CECL. So though CECL becomes when CECL becomes effective, and it's now effective at different times for different banks, but when CECL becomes effective as an accounting standard, we will phase in over the course of 3 years what the effect of that is in the capital regime for the banks. And if we see that there is a large increase in the reserve position of the banks, that's one of the reasons why I've been emphasizing that we think that the total amount of loss absorbency in the system is about right. I think then, as part of this overall assessment of the implementation of the remainder of Basel III, of the implementation of CECL, of looking at the effect of the existing framework, in order to ensure that we keep the existing high level of loss absorbency without either lowering it or increasing it, there will be recalibrations of a number of things that may be appropriate, and we'll look at that as it evolves.
Thank you for the answer. I'm not sure I agree with all that, but we'll move on. Ms. McWilliams, one of the top two issues is CECL and data aggregators, data privacy, when I talk to banks and credit unions. This is their number 1 and 2 issue. Data aggregators is something we had a hearing on a couple weeks ago, and there was a big article in one of the political rags just yesterday or day before with regards to the hearing that we had. And the concerns that are there with regards to these data aggregators coming in, screen scraping. I've had discussions with one bank, in fact it's been verified by a couple other banks I've talked to since then, that basically 80% of the transactions and searches that are done on their computers at night are done by these data aggregators screen scraping. They've actually had to increase the amount of computer power to be able to allow their own customers to be able to access their own accounts, as well as these data aggregators. Do you see the risk in this? Because there's been some huge losses in this already. What do you think we need to do as a regulator? Are you as a regulator, or is the industry going to take care of this? Is technology going to take care of this? Or where do you think this is going? As a regulator, does this concern you?
It does concern me, and frankly, it concerns me both from a regulatory perspective, but also from a private citizen perspective. And having grown up in a system that did not have and afford privacy protections for its citizenry, I am concerned whenever anyone's privacy could be invaded inadvertently even. From a regulatory perspective, there are a number of different privacy laws that we can implement. A lot of those privacy protection laws have been shifted to the CFPB by Title 10 of Dodd-Frank. In fact, 17 consumer protection statutes were sent over to the CFPB. We have some ability to implement and protect consumers in this space, but a lot of that ability now rests with the CFPB and the FTC, Federal Trade Commission.
Mr. Hood, Chairman Hood, do you have any concerns with that at all?
I share those same concerns as Ms. McWilliams. These are efforts that we all need to work together with. We certainly work with CFPB in addressing these issues.
Okay. I see my time is about up here. Just maybe a shake of your head would work here. But another issue has come to me with regards to the credit unions buying out banks. And that is something that's on the radar in both groups. And I'm fearful of a war beginning to break out. Are you guys at all concerned, Mr. Hood and Ms. McWilliams? Are you concerned at all?
Well, sir, these are voluntary market-based transactions.
Ms. McWilliams,
About 28 banks have been acquired by credit unions since 2011. There are additional mergers pending. Yes, we are looking at this. The two entities are just not set up together in the same way, and Congress did it for a particular reason.
The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you very much, Chair Lady. This is an important hearing, but we got a hole right in the middle of it, and that's because Mr. Arding is not here for whatever reason. But let me just tell you why. We're dealing with this burgeoning industry of fintechs. There is a crying need for us to understand, and I hope, Chair Lady, that we will get Mr. Arding here. Now, let me tell you why this is a missing hole. As you know, Chair Lady Waters, the OCC has announced a special order for non-bank fintech companies. However, that order has been opposed by state regulators. and also failed to generate any interest from the fintech industry itself. And that has been likely due to a lot of concerns, and I want to get y'all response on what these concerns are as much as you can. But here are some real concerns and why Mr. Otting not being here creates a hole in our discussion. Some fintech companies are disappointed in the OCC charter because of its limited purpose nature. Does not allow fintech companies to hold deposits or secure FDIC insurance for deposits. Then we got legal concerns. The OCC has been engaged in a lawsuit with the New York Department of Financial Services regarding the charter. And in October, the federal judge sided with New York against the OIC and says that the OCC does not even have the authority to issue a charter for non-bank entities and fintech that cannot secure FDIC insurance. You see why this is so important? And here we got the OIC, the OCC says it will appeal. Mr. Otting should be here to give us some answers to this, to speak to this. I think it's important also, Madam Chairlady, to find out why he isn't here. Everything that I am saying, he knows. We can't move forward. This is why there is a crying need for the bill we're working on with Ms. Waters, Mr. Lynch, I think Mr. Hill, as we're dealing with the need for you all to harmonize. And here's the main actor, not even here at this meeting. Now, I want you, Ms. Williams, to respond to some of these concerns. Are you aware that the New York folks have said that OCC doesn't even have the authority? Are you aware of the legal ramifications here? Can you imagine if you were a fintech and you've got a charter and there's no harmonization between you, between the Fed, between the CFPB, between the CFTC, between all of these regulators here biting at the bit to pounce on these fintechs and regulate them. And the chief regulator who has put forward an order that has been declared unconstitutional isn't even here.
Thank you for the question on fintechs. I can't speak to OCC's intention or actions, but I can tell you this. At the FDIC, we're very focused on making sure that there is both harmonization of the rules and a comprehensive look at our regulatory framework. Fintechs are something that's happening. Financial technology innovation is not new, but the ability of these companies to actually both do business and evolve with technology and their agility is something that's very new. So at the FDIC, we're looking at this. We're creating an office of innovation to deal exactly with these issues. And I can tell you also that any entity that seeks to collect deposits has to go through our application process for deposit insurance. And no matter what the entity's structure is, they will be subject to the same statutory requirements.
The gentleman from Michigan, Mr. Huizinga, is recognized for 5 minutes.
Thank you, Madam Chair, and I'm going to real quickly move through a number of things. But Mr. Hood, Chairman Hood, I understand that credit unions purchasing banks, traditional banks, is I believe the phrase was that you used a private market transaction. Fully understand that. The question is, do you see any problems with that?
Well, sir, these are transactions, again, that they are voluntary.
I understand that. Is there a problem with those transactions?
These are transactions that must be approved by both the FDIC and the
So you see no
NCUA.
problem with them?
I see
Okay, that's fine. If that's your answer, that's fine. That's fine. Chair McWilliams, if you could elaborate a little bit on that.
I do believe that, and we have data to support this, that there is a great consolidation in the community banking sector, and frankly, I'm concerned about the communities that are losing banking presence. We have over 120 counties that have a single banking presence in their county, and we have about 30 counties. So with respect to the credit unions and community banks, Congress set up credit unions in a certain way. They're not subject to taxation, and they also don't have CRA requirements imposed on them.
I think you're getting to that there might be a problem.
I'm getting to that the playing field may not be exactly leveled.
Okay, fair enough. All right, Chair McWilliams, ILCs. I want to talk a little bit about ILCs. The critics of ILCs claim that banks owned by non-financial companies are unsafe because these parent companies might conduct unsafe transactions with the subsidiary bank. Can you describe the existing statutory and regulatory framework that prevents such transactions?
Congress gave us the ability to approve ILC applications based on the same statutory requirements that we approve the deposit insurance applications for banks. So if a bank or an ILC applies for deposit insurance, they have a set of about 5 or 6 different statutory requirements, which we have interpreted through our regulations over time. We certainly look to the parent. We want to make sure that the parent is profitable. We also have the ability to ask for capital and liquidity agreements between the parent and the subsidiary so that the...
So at the end of the day, you believe that the regulatory structure is there in place, correct?
I believe that Congress gave us enough to successfly manage and regulate.
Well, I'll just note that in 2007, former FDIC Chair Sheila Bair had testified exactly to that, and that they may actually contribute significantly to community reinvestment. So I would assume you believe that still applies today.
I don't know exactly the full statement she said, but in general...
She just said that they proved to be strong, responsible parts of the nation's banking system and offered innovative approaches to banking.
I would agree with that.
Okay.
Yes.
Chair McWilliams and Vice Chair Quarles, your respective agencies study consumer financial welfare, which your data has shown that nearly half of Americans cannot afford a $400 emergency that could creep up into their lives, and they simply don't have the cash to deal with that. For many of these folks, including many in my district who are not prime borrowers, this source of small dollar credit line is a lifeline on those small dollar loans. And based on your experience and research, what do you believe would be the impact of a national 36% APR cap on the access to this type of credit for these consumers? Mr. Quarles?
So we haven't studied quantitatively exactly what we think that the quantitative impact of that would be.
Okay.
I believe that wherever Congress were to set that cap, there would be a significant portion of small dollar borrowers that would be excluded from the ability to get access to credit.
You certainly have been looking at the validity of loan terms, I'm assuming. It's my understanding that you're tackling serious systemic issues on safety and soundness. Is that true?
Yes.
Okay.
We take I would say, holistic look at the underwriting standards to understand how they impact safety and soundness and consumer protection.
So, and what does that mean for the greater marketplace for those types of loans?
For small dollar loans in particular, there is definitely a need.
Okay.
And that need has been identified by, I believe, about 40%, if I recall.
And how does the Madden decision figure into that?
The Madden decision, frankly, disrupts the over a century-long precedent that we have had that allows, Congress made it legal to allow banks to originate loans, and basically what the Madden decision disrupted was the ability of a bank to sell the loan and the ability of the purchaser to assume the interest rate under which that loan was sold. And frankly, it's a disruption in the secondary market which affects safety and soundness.
Thank you.
Thank you. The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to our witnesses here. Prior to the last crisis, one of the fundamental mismodeled risks was that of the bond ratings produced by the rating agencies were just flat out wrong. And U.S. corporate debt has now swelled to nearly $10 trillion, which is almost 50% of GDP, and is well in excess of any previous record, and actually well in excess of where it was pre-crisis. Experts from the IMF to asset manager BlackRock to the Fed have recently warned that the risk posed by ballooning allegedly investment-grade debt may pose to our economy. According to the IMF report on financial stability this year, it was the weakest firms that accounted for most of the growth and are increasingly using debt for financial risk-taking, such as investor payouts that lever up the company, M&A activity, rather than capital improvements such as plant and equipment. They're doing this apparently in response to both interest rate and tax policy. The problem is, of course, exacerbated by the fact that the bond ratings remain fundamentally suspect due to Congress and everyone's failure to deal with the fundamental conflict of interest in the issuer pays model for bond ratings. So, Vice Chairman Quarles and Chairman McWilliams, would you agree that this assessment of the growingly risky nature of corporate debt that's emerged over the last year?
Well, I think that's a complex question. Corporate debt has been growing. The debt service burden has not been growing because of the low level of interest rates. The structures in which the riskiest debt are held are generally not runnable structures, and therefore, by which I mean...
Could you elaborate on that?
Yeah, exactly. By which I mean that the terms of a lot of this leverage lending is being sold into collateralized loan obligation vehicles, and the holders of those vehicles, the maturity of their obligations, their exposure, is longer than the maturity of the exposure inside of the institution, and therefore it's difficult for them to run from the institute, from a precipitate change in the value of the underlying assets. So what does all of that mean? I look at that as saying there's much less of a financial stability risk of this, but I do think that there are, there's a possibility that there could be a decline in value of these assets, and that could exacerbate some future business downturn.
Yeah, so how do you model in your stress testing, the potential detonation of this $10 trillion unexploded bomb?
Well, we have, our models take into account the expected losses of different classes of assets. We do take the credit quality of these assets into account in the course of that.
Do you model the possibility that there are just fundamental errors in the bond ratings?
Our model does not rely entirely on the bond ratings in determining the losses that are expected here, and certainly not for the loans as opposed to the bonds that are part of this phenomenon. But I do think that there are supervisory actions that we can take and that the agencies together have taken through the Shared National Credit Program to address this issue. We have looked at leverage lending in each of the last 2 Shared National Credit examinations. It's been a particular focus, and where we have seen origination practices that we don't think are consistent with safety and soundness, we have taken supervisory action against those as part of that process.
Yeah, Chairman McWilliams?
It's as Vice Chairman Quarles said, it's a very complicated issue. We have engaged in the SNCC, so-called Shared National Credit, or SNCC review, every Q1 and Q3 of each year. Our teams get together and do a review, and we publish the findings in January, so there should be a forthcoming review of the Shared National credit portfolios at the banks. The $10 trillion that you mentioned, not all of that is leveraged. That's corporate debt in general. According to our estimates, about less than a quarter of that is so-called leveraged. One of the issues we're running into is that there's no common definition of leveraged loan. And so,
It's sort of similar to what became toxic assets, where there wasn't a clear definition of what was what there.
I would say there's some distinction there, but we have, and I know this is important to you, it's important to us as well. I have instructed our examiners and supervisory folks to go back and take a look at, what are these banks claiming as leveraged lending? So when you look at the, $10 trillion number, for some of these definitions for leveraged lending are 20 to 25 pages long. And some include indirect exposure, some include only direct exposure. So we are trying to get to a best place where we understand what's being held directly by banks, which we know, versus what's being indirectly outside of the banks.
Thank you.
The gentleman from Ohio, Mr. Stivers, is recognized for 5 minutes.
Thank you, Madam Chair. I want to thank you for holding this hearing. It's an important hearing, and I, like you, look forward to speaking with the Comptroller when he does come before the committee, because I think it's an important regulator. Appreciate the three of you being here. Ma'am, you can't see me because Mr. Rose's head is right in the way, but there we go. My first couple questions are for Governor Quarles. You recently had a conference in Abu Dhabi on IAIS, and Treasury and sort of Team USA was there. Treasury put out a statement afterwards saying they couldn't support the IAIS proposal on version 2.0 because they didn't feel like U.S. insurers should face pressure to participate in a reference ICS that is not expected to apply to the United States and doesn't fit our markets. They also thought that this current ICS could risk limiting U.S. consumers' access to important long-term savings products. Do you agree with the statements that Treasury put out?
I think the Treasury articulated serious issues, and I agree that those are issues. As you know,
And is Team USA together with one strategy and goal at these meetings? That's the intention of the question here.
Yeah. So yes, I mean, I think
there we
that I think that the Team USA, the three elements of it, the National Association of Insurance Commissioners, the Fed, and the Treasury, continue to work to the same objective. As you're aware, in Abu Dhabi, the NAIC sort of took the lead in negotiating a compromise. As with any compromise, there are issues around it. I think the Treasury was correct in highlighting those issues. The Fed believes that that it was, however, a compromise that allows us to continue to achieve U.S. objectives in the ongoing IAIS process, and so we're supportive of it.
It at least moves the ball forward, but I think we need to keep our eye on the ball and make sure that we're all looking out for the American consumer and American companies being competitive internationally. So I appreciate that, Governor.
Yeah, completely agree with that.
Great. So the other thing I want to talk about is the aggregation method and building blocks approach that you're working on. The Fed's developing a building blocks approach for a number of insurers that are supervised by the Federal Reserve Board, and it's significant in an international context, given that the first proposal included a realization that the aggregation method is being considered by the AIIS. And I'm just curious, I hope you'll consider, because this is a pretty complicated thing, I believe the Federal Reserve has gotten letters from the U.S. Chamber of Commerce, APCIA, the ACLI, NAMIC, and the Insurance Coalition asking you to extend your December 23rd comment period deadline, because these are very complicated proposals that affect a lot of people in a lot of different ways. And so this is not a question as much as a statement. I genuinely hope that you will consider their request to extend the comment period, because these are very important outcomes and very complicated matters.
Thank you, and we will.
And I'm not going to put you on the spot to ask you whether you will or won't, because that you might say no, and I don't want you to say no. I want you to consider it.
We will consider it.
Great. And I want to follow up on something my colleague from Missouri, Mr. Lukemire, talked about, the Cecil rule, and I think his next grandson is going to be named Cecil. He talks about it so much. So, Governor Quarles, will the Fed consider giving institutions credit for their Cecil reserves in overall capital standards as we move forward? That seems to be the way where we can make a change that allows what could be excessive reserves to be normalized and still end up with the right number of capital and not deny these institutions the ability to lend and grow our economy.
Yes, while we haven't made any sort of a decision until we see exactly how Cecil operates in the real world as opposed to through modeling, I think that is something that has to be on the table.
Great, and real quick, down the line, CRA, should we have a consolidated approach, an interagency review of CRA to make sure it works for all institutions? I know that it doesn't apply to credit unions today, but frankly, a lot of big credit unions, I think, do need it. So I'm going to ask you to comment anyway.
Well, credit unions, through their mission, it's based on the premises of people helping people. They are serving people of low to moderate incomes already through the products that they're offering, through their activities in the community by way of investment. So I would say that credit unions do not need government fiat to encourage them to do the right thing.
I'll follow up in writing. Thanks, Madam Chair.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair for the Subcommittee on National Security, International Development, and Monetary Policy, is recognized for 5 minutes.
Thank you, Madam Chair. Mr. Quarles, let me make sure that I get a good understanding. A lot of us, primarily our leader, was instrumental in getting Dodd-Frank approved, and there were provisions in Dodd-Frank that gave the responsibility to the Fed to implement a number of our provisions, the provisions of Dodd-Frank, including the mandate to preserve and promote MDIs. The numbers are ugly. 66 MDIs have been lost since 2008. We had 215 in 2008 compared to 149 in 19. I should have probably provided this before we started, but this is a chart that deals with MDIs, and it is not a pretty chart. I'm interested in you or someone explaining to me how did you handle the mandate to preserve and maybe even more importantly promote MDIs.
Thank you for that. We have taken that responsibility very seriously. We've established what we call the Partnership for Progress throughout the Federal Reserve System, which is a national outreach effort using the resources of the Fed to help minority-owned depository institutions, to how they'll address the unique challenges of their business model. That's that PFP program, as we call it, is very active in all of the reserve banks. And we have the resources behind it in order to help minority institutions throughout the country.
So you're saying you have promoted and continue to push for a reversal of the trend.
Yeah, absolutely.
So I'm interested, if you did, why has it failed? I mean, you would agree that, I mean, I'll give you this chart, it's very ugly. And so it means that something has not worked. I mean, if you're putting forth an effort and we go from 215 in 2008 to 200 to 149, we're hustling backward.
So the challenges that face minority institutions and community banks in general.
The gentleman will suspend. Mr. Cleaver, I want to put your chart up that you're referring to so everybody can see it. So just hold on for a minute and we'll get it up. I want to make sure that it is available to both sides and everybody.
I apologize. I didn't know I was going to go there until I listened to them.
Can I talk for a bit while the chart is going up?
Yeah, talk to the
Gentleman
chair.
will suspend. That way we'll be consistent. Please go right ahead.
Thank you, Madam Chair. So you can see this FDIC insured minority depository insurance, and then if you look down, you can clearly see as time moves on, things get worse. And I will hopefully you can take this with you when you leave. But my question is, if that's correct, and I'm 100% certain that it is, who's working on this?
So I believe that that is correct, and we are concerned about that trend.
I know I don't like to interrupt people, but you're saying you're concerned. I am too.
But we are regularly engaged with these minority depository institutions. In addition to the Partnership for Progress, where we provide them technical assistance, we have other sorts of technical assistance programs. We have a regular minority depository institution leaders forum that we host at the Fed. The interagency process has a separate minority depository institution technical assistance program that we provide, conferences that we provide for them.
Okay, thank you. Anybody else?
I would like to, if you don't mind, just add something. Section 308 of FIREA gave us the responsibility to protect and preserve the minority depository institutions, and we take that mandate very seriously. We have done a number of things at the FDIC to strengthen the ability of the MDIs to survive. I, like you, am actually, frankly, very concerned about the disappearing landscape of American minority depository institutions, and in particular of the African-American depository institutions. One of the things that I ask our staff is to analyze exactly what's the impact of our regulations, and do we understand how these MDIs can be helped. This is the bottom line. A lot of them need capital infusion, and frankly, I think there's an opportunity to address that in the CRA. And that's why I would just ask you to be open-minded to the changes we can make in the CRA to benefit the MDIs.
The gentleman time, so thank you. Gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Madam Chairwoman. To the witnesses, as you know, Kentuckians have a deep history and interest in the production, cultivation, and sale of industrial hemp. That dates back to Speaker Henry Clay. The hemp industry in the Commonwealth is booming. However, despite the legalization of industrial hemp in the 2018 Farm Bill, hemp farmers and producers and hemp-related businesses have had trouble accessing financial services. As you may know, I authored an amendment on this issue that was included in the Safe Banking Act, which the House passed in September. My amendment would require your regulatory agencies to issue guidance confirming that industrial hemp and hemp-derived products are legal and that banks don't need to file suspicious activity reports solely because a transaction relates to hemp. I want to thank you and your agencies, along with FinCEN, for issuing that very guidance. I believe it was issued yesterday, along those lines that will help the hemp industry in my district gain access to financial services. Chair McWilliams and Vice Chairman Quarles, your agencies issued that guidance that clarifies the legality of industrial hemp and states that banks are no longer required to file suspicious activity reports simply because their customers are engaged with hemp growth or production. I have heard from Kentucky bankers about this. They welcome this guidance, and it will go a long way to help the hemp industry thrive. Chair McWilliams, what plans do you have in place to train your examiners about how they should supervise institutions in light of hemp's legality and your guidance?
So we do, thank you for that question, and I think the guidance that we issued was crucial in making sure that there is at least some form of a roadmap for banks engaged in banking hemp-related businesses. We have done training with our examiners, and we will continue to do extensive training with our examiners to understand exactly how to look at these filings and to make sure that they understand that the suspicious activity report filings are not required for hemp-related transactions.
Thank you, and Chairman Hood, thank you for being first in line on this with your August 19th interim guidance on credit unions serving hemp businesses. What is your timeline for releasing updated guidance?
Well, we are continuing now, sir, to work with the industry to provide training to our examiners. We're also working with the state supervisory authorities to engage them in the process as well. We will now be working with the USDA and other related parties to ensure that we get it right. We will be hosting a series of roundtables to glean insight from entities and to glean insight around best practices. So
Thank you.
We're moving forward.
Thank you to all of you on this. One of the specific financial services which has been either unreliable or unavailable is card processing services. Does your guidance from yesterday clarify for card processing businesses that they can freely serve customers of hemp-related and specifically CBD retailers without any legal risk or liability?
I don't have the guidance in front of me, but we can circle back. I don't recall if that's...
Well, I've read the guidance closely, as you can tell, and I didn't see that in there, and that's the financial service that's really been unreliable and spotty. And so if you need to update that guidance to give more legal clarity to card processing businesses, I think that might be in order. Do you have a response to that?
We'll certainly take a look and make sure that we communicate with our regulated entities to see what's working and what's not vis-a-vis our guidance. And to the extent that we need to do additional explaining, we're more than happy to engage in that process.
Well, I'll just tell you that congressional intent is that not only that the regulators confirm the legality of industrial hemp and hemp-related retailers under the Farm Bill, but that those retailers and merchants can use card processing services to sell the product itself. And that's been the financial services issue for the most part. So I would ask all of you, if you need to revisit the guidance, to do so, to make sure that hemp-related businesses, legal under federal law, can offer those card processing services.
We will, and we will certainly make sure that we implement congressional intent as intended.
Great, thanks. Let me move on really quickly. Vice Chairman Quarles, would you describe the criteria you use to evaluate non-GSIB firms for inclusion in the Large Institution Supervision Coordinating Committee portfolio, the LISIC portfolio? Would you describe the criteria?
Well, the issue with that question is that actually the criteria are under active review, so we are in the middle of developing a more concrete and transparent
I would encourage a clear off-ramp that firms may elect to exit the LISIC portfolio. Finally, on leverage lending, Vice Chair Quarles, do CLOs provide liquidity in stressed market environments as long-term non-mark-to-market investors, and how might an overreaction to leverage lending undermine financial stability?
I'm not sure I'm going to, I'll follow up with you.
Thank you. I yield back.
The gentlewoman from Ohio, Mrs. Beatty, who is also the chair for the Subcommittee on Diversity and Inclusion, is recognized for 5 minutes.
Thank you so much, Madam Chairwoman, and to Ranking Member and to our witnesses. Thank you for being here. I have a few questions I'm going to try to get through in my time period, but first, after being in the anteroom and hearing part of the testimony and questioning from Congressman Cleaver, I'd like to share with the witnesses that Congressman Meeks and I both have a bill that deals with DIs. And so one of the things, since it was brought to my attention that you could not answer the questions about the MDIs, would you be willing to send me a briefing page on whatever your analysis or whatever you have, and maybe our staffs can work together? Is that a problem for anyone?
No, our staffs can always work together.
Okay.
We would be happy to engage.
All right, thank you.
Congresswoman, I just wanted to share that our credit union data was not reflected in the chart. We at NCUA are working with roughly 500 minority depositories. We continue to marshal resources to ensure their viability so they can serve communities in need.
Thank you so much, Mr. Hood, for that, and we'll see if when you all get together, you can certainly incorporate that data. We've heard a lot about the role I play as chair of the Diversity and Inclusion Subcommittee, and it's very important to me for a whole host of reasons, because I think it goes far beyond Dodd-Frank and Section 342. Very appreciative that you have OMWI directors, but I think it goes over into other things, whether that's MDIs, whether that's looking at what happened on November the 19th with the FDIC when you voted unanimously to issue a proposed rule to codify longstanding guidance that allows applicants with minor criminal records to work in banking. And Ms. McWilliams, this question is going to be for you. While I understand clearly the intent of the law, but it's a lifetime ban for any criminal offense regarding dishonesty, breach of trust, it seems to me that it goes far too far and captures too many other minor offenses. I was just at a meeting this morning when someone shared with me that when in college, their child's roommate had a fake ID. And the consequences ended up more than just a slap on the hand. And so as we talk about moving forward, let me just be real direct. I really have a problem with the decision and what you just did. So Ms. McWilliams, can you explain why the FDIC made the decision to move forward with this rulemaking? And let me remind you, it was a rulemaking from 1950.
I believe we have a common problem, and I'm not in disagreement with you. What we tried to do on Section 19 and the proposal we issued was basically to update the, as you mentioned, some of the archaic standards that Congress put in place for the inability of persons who committed minor infractions and have paid their debts to society and redeemed themselves to be able to re-enter workforce at banks. So I'm in complete agreement with you that we can do more. And our November initiative was exactly aimed at that, and the initiative received the unanimous vote of the FDIC board. So I'm not sure exactly where we're in disagreement.
Okay, we'll take a look at that. Can you tell me, Mr. Quarles, what's the topic of today's hearing?
Oversight of the bank regulatory agencies.
Everybody else had other words in theirs, like safety and diversity. It was a long title. And so let me just make an observation. When I look at Mr. Hood's testimony and what was sent out to all of us, it does say that it is the oversight, but it says ensuring safety, soundness, diversity, and accountability. And both of your colleagues took great pain to write about diversity and inclusion and to share that. So if I were doing just a mock little study and I'd say we have an African American, we have a female, and we have a majority, I find it quite interesting that the female and minority talked about diversity and inclusion as it related to soundness and as it related to regulations, and nowhere in your written testimony did it say anything about diversity at all. But yet you had some very interesting statement when you said financial regulation, like any other policy, is a product of our history. And so I'm going to use that and say back to you, I think diversity, or lack of it, is a product of our history. And I yield back.
The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Madam Chair, and appreciate the panel taking time to be able to be here today. I did want to follow up a little bit on my colleague, Mr. Luchtmeyer's questions in regard to CECL. There was a recent CSBS survey of 571 banks that found that only 60% of the banks think that they have adequate internal controls to be able to handle CECL. 22% think that they will need to obtain more, and 18% do not know. And Vice Chair Quarles, I guess one of the concerns that I have, some of the banks, 60% think that they're going to be able to handle it, but is the ultimate outcome in terms of a downturn in the economy. The ability to be able to make loans to consumers maybe when they need it the most. Is that part of the equation being included in some of the formulation for CECL?
I mean, so there, as you know, there's a limit to what we can do with the accounting standard because we don't create the accounting standard. But as we look at what the potential effect will be, and as we monitor the implementation of the accounting standard during this 3-year phase-in that we have established, we obviously will be looking at all of the effects that it has on the industry and on individual institutions.
Well, one thing just really to encourage. I come from a rural area, and oftentimes it's hard to be able to get access to capital for businesses to be able to operate. Some of the impacts that this could ultimately have on some of our regional banks in particular that play a very critical role is something that I hope that you will give a lot of consideration to. And did want to also be able to return to some of the CRA, and appreciate the comments my colleague Mr. Meeks made. But Chair McWilliams, we didn't really get to hear from you some of the goals of the CRA modernization that you'd like to see if you do in fact indeed join with the OCC in putting forward those proposals.
Thank you for the opportunity to clarify that. From my personal perspective, the CRA reform, frankly, the regulators have not touched the CRA regulation since 1995. The way that banks do business has changed tremendously since that time. We have more banks engaged in digital offerings, and yet the definition of the assessment area is decades old. And so the goal that I have personally is to modernize the provisions, to address some of the digital lending channels, to figure out how can we do more to encourage long-term investments and not just have banks look at a 3-year cycle as they look to make these investments. I believe if they have a long-term view, they will have a bigger impact on their communities. I think there's a whole lot more we can do for rural areas, for small farms, family farms. There is more we can do for small businesses, minority depository institutions, as I discussed. There is certainty we can provide in the marketplace that frankly is now lacking. We do not want to have, at least from my perspective, an exercise in Community Reinvestment Act compliance where the banks just get the numbers and check the box and they're done. We want to have meaningful impact on the ground in the communities that they serve.
I appreciate that and really encourage broadband development in rural America as probably one of the more important issues that we need to have. Vice Chair Quarles, could you maybe explain some of the reservations that you might have in joining the FDIC and the OCC in regards to CRA modernization?
Well, I think it's important to stress that we have been working jointly with the OCC and with the FDIC on CRA modernization. And that there is a shared view among all of the regulatory agencies, among community groups, among everyone, among banks, among everyone who is affected by this regulation, that that the regulation can be improved, that the implementation of the statutory requirement is not as well served as it could be by existing practice. We have. And I wouldn't get, too wrapped around the axle myself around the agencies potentially moving at different speeds. The OCC went out with its advance notice of proposed rulemaking by itself a while ago without the FDIC or the Fed. The Fed had a broad outreach in all of the reserve banks in order to get input. The OCC chose to do it through an NPR. We had a different mechanism. The FDIC had its own mechanism. And then we all took that input and worked together to reach an endpoint. We are only at the point of whether a notice of proposed rulemaking will go out. We're not at the point of a final rule, and the objective ought to be that at the end, all three agencies will join in a final rule, and we have our independent processes for how we will get there. So I think it's premature to say that we are parting ways.
Yield back. Thank you.
Thank you. The gentlewoman from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you, Madam Chair. I appreciate all of you being here. I want to talk a little bit about rent-to-bank schemes. Banks are generally exempted, as you all know, when they offer credit from state rate caps that cover payday lenders and other online lenders. For many years, these payday lenders and others have attempted to take advantage of this exemption by entering into rent-a-bank schemes, where they launder their loans through banks and then purchase those loans back, but continue to charge the high rates that would be illegal under current state laws in those places. You know, Chairwoman McWilliams, you had expressed your desire to see responsible lending take place inside banks. You've also said the agency frowns upon arrangements between banks and non-bank lenders for the sole purpose of evading state law. However, the proposed rule, if I may submit it for the record, Chairwoman.
Such is the order.
Thank you. It says the complete opposite. You allow the exemption to continue under these proposed rules from OCC. As we speak right now, you're supervising the bank FinWise Bank of Utah is facilitating essentially a shadow banking scheme right now in Michigan, where the op loans or whatever that they call make predatory lending 160% APR. But in Michigan, we pass laws that basically say the rate installment loan should be at 37%. I'm just curious, Chairwoman, tell me, isn't the op loans rent-a-bank scheme sole purpose evading state law?
I can't speak of a specific bank or a specific product. I can tell you that, and I hope that you have the FDIC proposal in front of you. The only thing we tried to do in that proposal, and we did, was basically seek information on almost 200 years of case law stemming to the Supreme Court.
But isn't the sole purpose evading state law?
We did not touch the issue that you're discussing, which is the true lender issue.
You said that you wanted to focus on making sure that we have responsible lending. These are payday lending. You know, my district, I have the third poorest congressional district. We're literally the frontline communities for these payday lenders. And we advocated on the local level. I was in the legislature for 6 years. We said we have to push back because it's increasing the cycle of poverty, right? And we're asking us to for us to know that when we see a scheme like this that is targeting communities that we're supposed to be protecting, that we're issuing proposed rules that basically protect it and to stop these schemes. I know these are not folks on the street, these are bankers, but these are so-called folks from the business sector and corporations, but they should be treated the same way as any criminal on the street would when they're trying to push something that is obviously laundering money through a rent-a-bank scheme, correct?
So there has been a lot of confusion about what we did and what we didn't do, and I believe you're talking about the doctrine of so-called true lender, which our proposal did not touch. Our proposal, the only thing it did, if you have the proposal in front of you, you will see the only thing it did is in fact address our long-standing principles that Congress gave us the authority to do in 1980, which is to say that when a loan is made and the interest rates are not usurious at the time when the loan is made, no subsequent event makes those loans usurious, basically preserving the sanctity of a contract to ensure that there's a secondary market for the sale of these loans. States do have an opportunity to opt out of that regime. Congress, you gave them that authority in Section 27 of the FDI Act as well. And frankly, we frown upon and we look disfavorably upon the schemes that you're talking about.
But why aren't we addressing it in the proposed rule?
Do you have our rule in front? We are.
Yes, it actually still does not allow, it allows them to evade the state laws. It allows them to hide, yes.
That is incorrect.
So right now, you're telling me these rent-to-bank schemes are illegal?
The rent-a-bank schemes that what you're referring to as rent-a-bank, it's not a regulatory term.
I know. What do you call
Those schemes are and arrangements are provided under the so-called true lender doctrine, which we didn't touch. It's up to states to decide what rate caps are appropriate, if any, and whether or not the states want to opt out of the ability of the interest rates to be preserved when an out-of-state entity purchases that loan product.
I think we need to shut down these schemes. We can call them whatever we want. My folks call them rent-to-bank schemes. We need to shut them down. State laws out there across the country are preventing this form of predatory lending, and we, as the government, are not preventing it from actually happening. We're not creating the safeguards that are available. So, Chairwoman, before I end, I'd like to submit some articles from the Center for Responsible Lending, as well as the National Consumer Law Center, that are talking about where around the country that these schemes continue to target people that we all represent. Thank you.
We're certainly not in favor of predatory lending.
Gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Madam Chairman, and thank all of you for coming today. With last week being Thanksgiving, I spent some time thinking about how blessed we are to live in the greatest country in the world. We are a nation of opportunity and incentive, and because of those principles, we are a nation of hope where everyone can benefit. As its core, it is capitalism and the free market that helps make this country so great. So it is a system that rewards innovation because it maintains demand for the best products at the best price. Now, I'm a car dealer, and I can tell you we've got good, really, prices right now out there, so you need to know that. So with that in mind, though, capitalism is the greatest force in the history of our world for lifting people out of poverty. And I pray that we will instill this virtue in future generations. So, Chairwoman McWilliams, back in May when I asked you if you were a capitalist or a socialist, you mentioned you grew up in communism, spent time in socialism, and now choose capitalism. So I would assume nothing has changed in your decision since May.
Nothing has changed in my decision since May, correct?
So, given your unique life experience with these economic systems, can you quickly elaborate on the beauty of capitalism?
I don't think that 5 minutes or 3 minutes and 38 seconds of your time is going to allow me an opportunity to speak of my appreciation of this system. But I can tell you that I'm teaching my daughter about the privilege of being born in the United States and the benefits bestowed upon anyone who has that privilege. I can tell you that as I was growing up, my father had to give up a small piece of farmland in order for me to qualify for a free school lunch, which was then revoked about 6 months later. And having the ability to protect private property ownership rights and the ability to live in a free and prosperous economic society that preserves the rights of the individual is something that I think is the greatest blessing in my life.
Well said, thank you. Vice Chairman Quarles, my colleague, Mr. Cyrus, touched on this earlier about the meeting in Abu Dhabi, and I think that maybe we could talk about that a little bit more. I understand that the IAIS agreed to enter a monitoring period for its global insurance capital standard, but did not formally implement the ICS due to ongoing concerns raised by our Department of Treasury. Well, last month's meeting seems to be a step in the right direction. I still have some concerns considering our state-based regulatory system that have been effective for the last 150 years. We must do all we can to ensure that whatever international standards agreed to, it will not put the U.S. insurance companies at a competitive disadvantage. So I have two questions for you, Vice Chairman. First, will you commit to staying engaged on this topic moving forward? And secondly, do you feel as if the results of the meeting in Abu Dhabi give us the ability to create our own domestic standard for insurance regulations?
I'll definitely remain engaged on this going forward, both through my work at the Federal Reserve and as chairman of the Financial Stability Board, of which the IAIS is a member. Did the agreement in Abu Dhabi give us the ability to continue to pursue American interests in this process? I think that it did. You know, as I indicated earlier, it was a compromise. It was a compromise that was negotiated by the National Association of Insurance Commissioners. By definition, no compromise gives every side everything that it would want, but I think that it gave us enough, by the United States enough, to continue to ensure that the international process takes account of our system.
Okay. Chairwoman McWilliams, in an op-ed you wrote for the American Banker in October, you stated the following: if our regulatory framework is unable to evolve with technological advances, the United States may cease to be a place where ideas and concepts become the products and services that improve people's lives. I completely agree with you with your statement. I think that one area that would be especially beneficial to update would be the broker deposit rules and regulations. So as you know, these rules haven't been updated in over 30 years and so are overly broad that they capture a wide variety of new companies that have been working to get more people into the traditional financial system. I know you've been working diligently on this issue and can't comment on specifics possibly, but I hope we will see something soon out of the FDIC on broker deposits. So, Chairwoman, other than the broker deposit rules, what has the FDIC been doing in the Fintech space to work innovation in the banking system and modernize supervision?
Thank you for that question. I think this is one of the underappreciated areas in the regulatory world because innovation seems to be happening and quite often it seems to be happening outside of the regulated entities. We want that innovation to happen inside the regulated entities, and I will submit for the record some of the initiatives we have undertaken.
Thank you very much. I yield my time back.
The gentlewoman from Massachusetts, Ms. Presley, will be recognized for 5 minutes.
Thank you, Madam Chair, for ensuring that oversight continues to be a priority for this committee. We have a government structure to work one way for banks and businesses and another for consumers and working families. That's why I push the Federal Reserve to provide everyday consumers with the same settlement services it already provides for banks. Working families shouldn't have to wait 3 to 5 days for a check to clear. Now, Mr. Quarles, you were the lone dissenter in the Federal Reserve's decision to develop FedNow, which was heralded by small businesses and consumer groups alike. I do believe how one chooses to spend their time reflects what they value, and more importantly, who they value. Mr. Quarles, over the weekend, the New York Times published a profile on your regulatory approach. And notably, you have chosen to spend your time in this role in your first 21 months in office. You met with Goldman Sachs 24 times. You met with J.P. Morgan 19 times. You met with Morgan Stanley 17 times, and with Citi 12 times. In that same time frame, how many consumer groups did you meet with?
Over the course of my first 21 months in office, I met with approximately, at a conservative estimate, 15,000 to 20,000 people. The great majority of those, you've noted that 26 of those were Goldman Sachs, out of 15,000 to 20,000 people. That's, again, at a conservative estimate, 0.14% of my time was spent with that, and the other 99.86% of my time was spent with others.
Okay, consumers? Because again, who you spend your time with speaks to who you value.
Yes.
And the fact that you were the lone dissenting voice about whether or not to expedite payments of hardworking Americans so that they can get what they've worked for in a 3 to 5 day period, something banks already have, I think is indicative of something else. But
ma'am, I dissented because I believe that the proposal would harm those consumers.
Reclaiming my time, again, you were the lone dissenter on that, and I asked, did you engage consumer groups, and you didn't indicate any. The Federal Reserve was noticeably missing from the recently issued notice of proposed rulemaking on the Community Reinvestment Act. A strong CRA is a top priority for civil rights groups and many members of this committee. Mr. Quarles, how many civil rights groups did you meet with in those first 21 months? Can you just name a few specifically?
I met with many.
ACLU?
I don't remember the names of them. I met with many, and we'll be happy to provide that information.
I would like to see that list, but I am incredulous that you cannot immediately cite civil rights organizations, knowing that what a priority a strong CRA is to these groups, and that you can't immediately detail or enumerate that you've met with any of them. So I look forward to that list. When Chairman Powell was before us, I called on the Fed to better reflect the interests of hardworking American people, a sentiment I echo to all regulators, including those who could not make it here today. However, when large banks have a greater access to the Federal Reserve's leadership than even sitting members of Congress, we have a problem. I want to be clear. My colleagues and I are paying very close attention. Wherever gaps in oversight exist, we fill them. hundreds of thousands of hourly employees doing the everyday business of banking, opening checking accounts, originating loans, detecting fraud, and money laundering, all while complying regulations. However, we have seen how extractive sales quotas and performance metrics can result in disaster for low-level employees. The Wells Fargo scandal is a prime example of this. So, Ms. McWilliams, yes or no, do you track banks' employment practices and metrics?
When you say employment practices, can you elaborate?
Well, some that I already cited. I spoke about just the everyday business and practices of banking, opening checking accounts, originating loans, detecting fraud, money laundering, and again, these extractive sales quotas and these performance metrics, according to those practices, can result in disaster for low-level employees.
I don't disagree with you that certain bank culture can certainly create problems for both the employees and their customers. In terms of tracking performance, we do have supervisory tools through which we look at the number of accounts opened. We look at how banks are conducting the business of banking. We make sure that they comply with the consumer protection laws and statutes.
Okay, thank you. I'm sorry, I'm running out of time. Mr. Quarles, do you track banks' employment practices and metrics?
We do.
Okay. And so in the wake of that scandal, thousands of frontline workers who lost their jobs while only a handful of more senior level employees face similar consequences. That is why, with the support of the AFL-CIO and the communications worker, I'm sorry, that's my time? Okay. All right, thank you, Madam Chair.
Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Madam Chair. Thanks for providing us the opportunity to have oversight over the bank regulatory system. I want to thank each of you for appearing today. Thanks for spending time with us. And congratulations for the hard work over the last few months to implement S2155 across the agencies. You met together, you had your checklist, you got that work done and reported that to Congress in a timely way, and all of us and our constituents, thank you for that attention. Mr. Quarles, I wanted to follow up on a discussion that we've had on and off over the last few weeks and talk briefly about bank supervision by the Federal Reserve as it relates to the September 16th, September 17th disruption in the repurchase market. I know that's being studied by the Fed in earnest, led by the New York Bank, and I appreciated that. But when you see the amount of reserves held by the banks, they're extensive. I mean, they're far above any requirement by the Dodd-Frank rules. There is very little chance of a foot fault in those reserves that I think particularly the big banks hold. In fact, looking at the numbers, the 4 largest banks collectively have more cash at the Fed than the next 24 combined. So there seems to be a lot of cash held at the Fed. How does the Fed make clear to banks that intraday lending is a good thing? In other words, that banks have access to those cash amounts that are far in excess of what they need regulatorily?
I think there are a variety of measures that we can take. We are actively looking at what will be effective. We do want to ensure that our supervisory, both the regulatory system and our supervisory practices are not creating undue incentives for the hoarding of central bank reserves by some institutions. Part of that is simply communication, ensuring that our supervisors are communicating clearly about what Fed expectations are. Some of it can be, taking measures to ensure that banks are comfortable that they will have access to immediate liquidity from other forms of, if they're holding other forms of liquid assets other than central bank reserves, and all of that's under active consideration.
Well, would you, certainly before the financial crisis, having a daylight overdraft at the Fed was considered a routine business activity. Would you agree with that?
Absolutely.
Had there been much to speak of in the ways of daylight overdrafts by the banking industry since the crisis?
Very little.
Would you say there's a stigma has been attached to having a daylight overdraft during an intraday process?
I think that's inarguable. We hear that from the industry.
So that issue is curious to me when I think Mr. Diamond at JP Morgan Chase reported something like $60 billion in cash was required that he keep that at the Fed, but his cash balance was like $120 billion, for example, on a daily basis. That seems like a lot of room to participate in that market if there was an economic incentive to do so. So assuming there's an economic incentive to have a rising repo rate, I'm just curious why that stigma is so pronounced.
Well, among the consequences of the increased transparency after Dodd-Frank has been a decreasing willingness of institutions to take advantage of some of the credit provision from the Federal Reserve,
right?
And that has contributed. Although I do want to emphasize that we don't think that it is the driving factor, but that has contributed to some of the.
Well, I've heard GSIB surcharges might contribute to it and others. But do you think Section 1103 of Dodd-Frank that requires the Fed to publicly disclose that banks borrowed at the discount window, that should be reconsidered?
I wouldn't go so far. I haven't concluded that it should be. Well, it depends on the definition of reconsidered. I do think we have to think about what the implications of it are. I certainly haven't concluded that it should be repealed, but we should be aware of the full range of its consequences.
Thank you. Well, I want to touch on a couple of other things. Chairman Luetkemeyer talked about screen scraping. I'd like each of you to answer this question. Do you support the use of APIs by financial institutions that you regulate exclusively for access to consumer data by data aggregators that aren't part of the bank? Mr. Quarles?
We do support the increased use of APIs as a more secure way of dealing with consumer data.
Would you require it, do you think, in the future, subject to a rulemaking and a process and all that?
We should give consideration to that. We haven't concluded we should require it.
Director McWilliams?
Generally in agreement, yes.
Mr. Hood?
General agreement, but I'd have to study it for its impact on our smaller institutions.
Thank you, Madam Chair. I yield back.
Thank you. The gentlewoman from New York, Ms. Ocasio-Cortez, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you to all of our witnesses that have come here today to testify and share your testimony. I'm here today, and my job here is to represent working people, and my district is quite working class. Many of my constituents are waitresses, they are teachers, they are nurses, and I'm here today to get to the bottom of a problem that our taxi cab drivers have been facing. As some of you may be aware, the New York City taxi medallion crisis has driven many owner-drivers targeted by predatory loans to financial ruin and suicide. Some of my colleagues and I have called on the city to forgive the debt of these drivers, and that has been met with resistance. But while you're here before the committee, Mr. Hood, I would like to discuss the role that NCUA played in the crisis and its ability to potentially provide relief as we explore solutions. Mr. Hood, you are the primary regulator for all federally insured credit unions, correct?
Yes, ma'am.
And as such, you would have been the primary regulator for Melrose Credit Union, Lomto Federal Credit Union, Bay Ridge Federal Credit Union, who all failed because of a significant concentration of loans collateralized by taxi medallions and unsafe and unsound lending practices, correct?
Well, the credit unions that you mentioned, they had pretty much an 80-year history of providing prudential mortgages to the taxi medallion industry.
Mm-hmm.
So they've been doing it for 80 years quite successfully.
Yes, but they did fail because that concentration became untenable for them.
It was a combination of concentration risk, but again, those loans were performing well. It was the introduction of the ride-sharing applications that really upended that traditional business model.
I think there's an issue there because the Inspector General at your organization conducted a material loss review, and they found that the examiners repeatedly noted that these credit unions began to be engaged in unsafe lending practices, including failure of the credit unions to fully analyze borrower financial information, insufficient detail in credit memoranda, risky loan terms. I mean, we're talking about some of these drivers were making $30,000 a year. We're giving $1 million loan. Do you agree with the characterization of the IG's report, Mr. Hood?
I certainly support the IG report in the sense that we are taking some of those actions to date now.
Great.
We're issuing information around guidance on concentration risk. But I would like to note, ma'am, that also one of the first things I have done in the 7 months of being at NCUA was to make sure that we have a senior leader whose sole responsibility is to look for borrower solutions for the individuals who have these loans. We're looking to provide them with restructurings, reduction in interest rates, and all the things it's going to take to make them whole. And I'd also like to note, my heart goes out, and I empathize with the families who have been impacted. With me, when I look at the taxi medallion situation, I know that behind every taxi medallion loan is a family that's been impacted.
Yeah, and you're aware that the examiners were sounding the alarm about this industry in 2012, 13, and 14 for 3 consecutive years, correct?
I'm aware of it because I now am at the agency, but those were activities that were taking place. And again, most of the institutions that you've recognized, those have all been conserved. Those have all been merged into other entities. First and foremost, the individuals that were credit union members, their accounts were remaining safe and sound, so they never once lost one of their insured deposits.
And I greatly appreciate the actions that have been taken to prevent some of these crises in the future. My concerns now are with those who have been impacted by these predatory loans. Do you believe the NCUA bears any responsibility for the findings in the Inspector General's report?
Well, I think it was important that the IG did note some things that we can do to further enhance our supervision efforts, not just with this one particular asset class, but in general, we're going to be looking at producing general supervision or guidance coming up in the next few months, I would say, around just concentration risk in general. But the thing is, there were so many other folks in the ecosystem involved with originating these loans. You had, as you referenced in your remarks, the Taxi Commission. You had state-chartered entities that were also making their origination.
Thank you. And I'm sorry, I just have to reclaim my time for the purpose of questioning. And as you said, there is a broad ecosystem. I'm trying to figure out what we can do here in this slice of it. Entities are currently selling the loans off to debt collectors at a discounted rate, yet owner-drivers are still on the hook for the original amount. So in other words, many of these predatory loans are being sold off for, say, $150,000 to a debt collector, but still holding the owner-driver to about a $600,000 a debt for the loan. Can I have your commitment before this committee that the NCUA will do everything in its power to ensure that any benefits extended to lenders could also be extended to owner-drivers in the form of principal reduction?
Well, we are looking at individual tailored solutions to address the matter at hand. It's not a one-size-fits-all approach. What I have instructed our staff to do is to work with those individual borrowers, and to the degree that they are providing us with information, ma'am, we're able to reduce their interest rates. We're able to provide them with a loan restructuring so that they
And what
can
about
make payments.
principal reduction specifically?
That my statutory requirement is to protect the National Credit Union Share Insurance Fund for the safety and soundness of the overall system. We are now working within the means that we have to date to support providing individual solutions.
Would you consider principal reduction?
That is something that would be difficult to do in managing my statutory requirements to the National Credit Union Share Insurance Fund, but I am open to looking at other activities to provide borrower relief by way of loan restructurings and interest rate reductions.
Okay,
and I
but
do want to work with these individuals.
Okay, thank you. We'll be following up.
Yes, and thank you for your recent letter.
Of course, thank you.
The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you all for being here today. I have 3 questions, so I'm going to try to get through them in my limited time here. First, Vice Chairman Quarles, I want to talk about LISIC. Trust you received the letter I led with 24 members of the committee regarding LISIC and the lack of clear, transparent criteria for designating firms. My question is, as you know, the GO can determine that at least three pieces of LISIC guidance are actually rules and must follow the rulemaking process. And so my question is, what is the Fed going to do to follow the required process and ensure that LISIC is transparent?
So we are in the process right now of considering refinements, revisions to the LISIC designation process that will make it both more concrete, more rules-based, and more transparent, and we'll be shortly working on those.
So your intention is to follow the rulemaking process in that?
I don't know whether we would, I don't know that it would go through sort of the Administrative Procedures Act rule process. But when we have completed rethinking about how we can make it, again, more concrete and constrained and transparent, at that point, then we'll consider if it is, even if it's not an APA rule, it could be a Congressional Review Act rule that we would send up
and
that way.
That was really the concern is if it does go under the CRA, we want to make sure that it's transparent, that we're engaged and involved. So
absolutely,
we'll be following up with you on that. And so thank you for that. Chairman McWilliams, want to talk about the valid when made issue a little further. I know that's been brought up already. Since the Madden court decision in 2015, it's really created a fragmented interpretation of banking laws and regulations. I mean, this thing is valid when made. It's been in play for a century and has brought stability. Ranking Member McHenry and I sent a letter to you that was signed with all the Republicans on this committee to you and Comptroller Otting in September, asking that if you would provide clarity on the issue, which will help keep credit accessible and affordable. Some have made the argument, as you have heard, that this rulemaking will allow non-bank lenders to evade state interest rate laws. Can you explain how that is not the case?
It is not the case, and I'll have to correct you. It's the original case was 1828 Supreme Court case, so it's a little bit more than a century, almost two. The only thing we did in a rulemaking, frankly, was take the guidance we have had based on the laws that Congress gave us in 1980 to ensure that there is clarity, especially in the secondary market, which we view as important for the ability of banks to maintain safe and sound standards as they look to sell the loans. That's all we did. We did not change the existing status quo on the authorities that Congress gave us in 1980.
So based on what you're doing, you can say that this rulemaking will not allow for non-bank lenders to evade existing state laws.
That is correct. The issue that Congresswoman from Michigan mentioned is something that we did not touch in our rulemaking. In fact, we specifically said the only even close reference to that is that we look unfavorably, and we will consider it unfavorably in our supervisory approach if banks engage in the practices that basically are deemed as predatory.
Okay, and I appreciate that because I think it's something that definitely needs to be done. It does affect the lending, especially between the Fintech industry and banks, and I appreciate the direction that you're taking on it. One last question for you, and it's regarding technology and especially artificial intelligence. As a new ranking member on the task force, I sent you a letter recently about the planning that you're planning to issue guidance regarding the bank's use of artificial intelligence. I think it's really important that as we develop the guidelines for banks regarding artificial intelligence, that the efforts are coordinated among regulators. And so will you make every effort really to everybody up here to work together to make sure that whatever regulatory guidelines that we put out there for the banking institutions regarding artificial intelligence are coordinated so we don't have disparity between the different regulators?
Yes.
Yes.
Thank you. Mr. Quarles?
Absolutely.
All right. Thank you. I yield back.
The gentlewoman from Virginia, Mrs. Wexton, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to the witnesses for joining us here today. I'd like to talk about something that impacts every American and especially my constituents in the 10th Congressional District of Virginia, and that's government shutdowns. The last shutdown that we had lasted for 35 days. It was only a partial shutdown, but it still cost the economy billions of dollars. 800,000 of federal employees went without pay. Tens of thousands of contractors were laid off, and unlike federal workers, they did not receive any back pay for their lost hours of work. And during this time, a lot of banks and financial institutions stepped up and offered to help folks who were affected by the shutdown. They offered things like flexible payment options and no-interest loans. And this was really important to especially people who work in the national security area because, financial difficulties can impact their security clearance, and then that jeopardizes their livelihood. And it was great to see so many lenders take these proactive steps. But there were still issues and confusions at some financial institutions, and regulatory guidance from your agencies was very slow to come. It, in fact, wasn't until the 20th day of the shutdown that joint guidance was released, encouraging banks to work with borrowers who were affected by the shutdown and let them know that such efforts would not be subject to regulatory criticism. During the shutdown that we had in 2013, it wasn't until the 9th day that guidance was issued. So this is not an isolated problem, and believe me, I don't ever want to assume that shutdowns are the new normal. But we right now are operating under a CR that is only good through December 20th. And I introduced a bill, the Shutdown Guidance for Financial Institutions Act, which passed the House of Representatives, that would basically automate the process and require that financial regulators get that guidance out within 24 hours of a shutdown. This is like hundreds of other wonderful bills that we've passed in the House of Representatives. It's sitting over in the Senate. It obviously won't become law in time for the December 20th deadline that we're facing. So what I'm seeking from each of you is an assurance to not just me and the members of this committee, but federal workers, contractors, and the financial institutions who are looking for this guidance, that there will be a timely issuance of guidance if we are not able to keep the government open come December 20th. So can I get that assurance from each of you? Mr. Hood.
Well, the credit unions weren't involved in that particular guidance. I'm pleased to report that our credit unions were making emergency loans and providing financial services without any regulatory guidance. They were doing it on their own volition because they wanted to help their members of those credit unions have access to financial services during the shutdown.
And you'll make sure that that continues in the unlikely event it becomes necessary again?
They have done it with or without my imprimatur, but yes, I will certainly encourage them to continue serving the needs of their member owners. But again, to date, they were doing it without any prompting from our agency.
Very good.
Thanks for highlighting the issue. We should be able to move much faster.
And as a fellow Virginian and somebody who spent a decade in public service prior to this job and depended on those federal government checks to make my mortgage payments, I actually want to thank you personally for your effort in this area. We took too long last time, and it shouldn't repeat.
Very good. Thank you very much, and I'll yield back with that.
Thank you. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
Thank you, Madam Chairwoman. I thank our witnesses for your expertise and the service you're trying to render to keep our banks and our markets sound. And so as we look at the hearing prior, one of my colleagues highlighted the Fed's faster payment program, and Mr. Quarles, your no vote. As you said earlier, you felt that it could harm consumers. I'd like to allow you a brief response.
Well, I think I think there are questions about the speed with which a faster payment system can be implemented in the United States, and what measures will ultimately be effective in doing that. At the end of the day, those arguments weren't persuasive to my colleagues on the board. I do think that one of the factors that it was very reasonable for them to take into account is that the Federal Reserve, with respect to the payment system generally, does not have regulatory authority, unlike most central banks and most of our peer, what we would consider most of our peer central banks. So in the absence of direct regulatory authority over the payment system in order to address some of the concerns that were being raised by consumer groups, it was felt that the only way to really do that was through direct, through standing up a direct Federal Reserve offering. I didn't think that was the most effective way, but I do think it highlights that weakness in our regulatory framework that other than doing this, we don't have a way of trying to ensure that some of these concerns are addressed.
Thank you for your explanation. Frankly, I had hoped that you would talk about the Fed's previous commitment that the private sector would take care of that, and frankly, having invested substantial capital in that space, now the Fed essentially wants to borrow that intellectual property for their own use. And I thought it was highly inappropriate, frankly, for the Fed to decide to move in on what they had already signaled to the market they would not move in on. So. And as you look at it, I hope that the Fed will continue to look at ways to tokenize the dollar, digitize the dollar, because that payment could be very swift and could make use of the underlying blockchain technology that is going to transform central banking around the world and hopefully doesn't leave out the United States. So thanks for it. And certainly, easier to implement than some of these things. Now, it does eliminate some intermediaries, which I understand some of those intermediaries might like to make a lot of money on the transaction fees or carry trade or what have you. But that highlights one of the other things where liquidity is just not happening the right way. Some of my colleagues have already looked at the repo market, and I just am particularly curious about the moral hazard of essentially the Fed interjecting $100 billion or so a day at times into the repo market. Do you see a moral hazard in that?
It's an interesting question. I don't think actually that there is a moral hazard there. Given the operating framework for monetary policy that we have described, we have to ensure and have said that we'll be following going forward. We have to ensure that there is an ample level of reserves. We always expected that as the level of reserves shrank, at some point we'd know when we got there because we would see a price response in the market. We hadn't expected that it would be so dramatic.
Well, how would the price response happen correctly if the Fed intervenes? And so you're preventing the market from functioning in a way because of Fed intervention. And when you look at the purpose of the hearing, I think nothing highlights better the fact that we might not have our regulatory framework dialed in correctly for financial institutions than the fact that our repo market is in chaos right now. And the only way to bridge that gap is to essentially print money. Although we're not calling it quantitative easing, and it has maybe a different intent, how does it have a different effect?
Well, I think it has a different effect because of the nature of the intervention. We are only trying to ensure that we get to that level of reserves that ensures that our administrative rate, in fact, is the price of money as opposed to
But rather than putting money into the system, why wouldn't you look at the regulatory framework that created the problem in the first place? And as we close in on the end of the year, many people are anticipating another surge in demand for liquidity. Is the Fed expecting that?
I do think that we need to look at the regulatory framework. I don't think that it's the only contributor, probably not even the driving contributor to what's happened, but we do need to look at it. I agree.
Thank you. My time's expired.
Thank you. The gentlewoman from North Carolina, Mrs. Adams, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you to all the witnesses for being here for your testimony today. My first question is to you, Chairman Hood. In October of 2018, NCUA amended its 2015 risk-based capital rule to delay the effective date until January 1, 2020, and raise the asset threshold from $100 million to $500 million in assets. In June of 2019, the NCUA again delayed the effective date to January 1, 2022. At this point, the proposed risk-based capital standards have been postponed multiple times. So does the NCUA have a timeline for finalizing the standards within the next 2 years?
Yes, ma'am. NCUA, first and foremost, the credit union system to date has a very strong net worth of over 11.39%. Because of that reason, ma'am, the recent NCUA board made the decision to delay implementation so the new members, 2/3 of our board, all started in April of this year. So with that being said, we're studying solutions and we're looking to provide a holistic approach to injecting capital into the credit union system. Where the aggregate net worth to date not at 11.39%, we would not have the comfort in taking this necessary time to study. But we do have the risk-based capital rule that's already in effect today. In fact, we have a rule that's not identical to that of the FDIC, but comparable. So there is a risk-based capital structure in place, and when credit unions fall below the statutory cap of 7%, we take enforcement and corrective action.
Okay, so we don't really need to be concerned about the capitalization within the credit unions?
I would say that we are well capitalized, and we will continue to look for innovative and adding new tools to buttress its capital adequacy. But right now, it's hovering over 11.39%, 400 basis points, so 4% above the statutory requirement. So we have time to pursue innovative options, and I hope to present them with you when I next testify.
Okay, thank you, sir. Vice Chair Quarles, in S2155, the Fed was directed to undertake a formal study to determine if banks with less than $250 billion in assets are not systemic. Is the Fed still planning to conduct this study, and if you're not, why not?
The reason I was looking back at my colleagues there was that I wasn't aware that there was a study requirement, and they have confirmed for me we did not believe there was a study requirement. We are, we're always looking at the systemic situation of the industry as a whole, but I don't think that the law required us to conduct a study.
Okay, that's a fake question, I guess. Okay, so let me ask. let me ask you that in terms of the loophole, in 2016, the Fed issued a report calling for the ILC loophole to be eliminated as it that generally exempts ILCs from the Bank Holding Company Act. So does the Federal Reserve still support that recommendation?
We have not had cause to address that. We have not changed our official position on that.
Okay, let me move on to the CRA. I think all of us can agree that it has served as an important tool in helping meet the credit needs of our underserved communities and populations. This question is for everyone. Briefly, can you speak to how we can better align financial profit incentives and the CRA incentives to ensure that more low to moderate income borrowers, small businesses, and entrepreneurs can have access to affordable, prudent loan options? So if each of you can quickly...
Credit unions aren't governed by CRA, but I support all financial institutions serving people of modest means.
Ma'am?
I believe we can reform the CRA to get exactly to the point you're addressing, and that's the effort I'm trying to engage in, to make sure that there is a greater impact on the communities that the CRA was supposed to and intended to affect.
Thank you, sir.
Yes, absolutely. I share those sentiments. We can do more, and we can do it efficiently.
Well, thank you all for your testimony and your responses. Madam Chair, I yield back.
Thank you. The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Madam Chair. Chairman Hood, great to see another North Carolinian in the room.
Thank you.
Vice Chair Quarles, welcome. One topic that I and others continue to be concerned about is the proper calibration of the overall capital framework. I've asked you and Chairman Powell several times about plans to update the GSIB surcharge, given that the Fed said it would do so in the final rule in 2015. So we hope to see some progress on that in the very near future so that the U.S. can continue to level the international playing field. Chair McWilliams, thank you to you as well for being here. I want to briefly echo the comments made earlier by my friend Mr. Tipton from Colorado and add my support to the FDIC to utilize its upcoming brokered deposit rulemaking to make some long overdue changes in updating how it interprets that area of the law, in particular if the deposits are coming from an affiliate of the bank. And Vice Chair Quarles, back to you. Regarding the topic of insurance, last July, I sent you a letter following a dialogue that we had at a hearing very similar to this, where I asked a number of questions about the Fed's activities at the International Association of Supervisors, including for evidence from a solvency standpoint to prove it's necessary to construct a new capital requirement for U.S. insurers. In your response, you said that the Fed remains committed to engaged dialogue in pursuits of outcomes on international standards that are appropriate for U.S. insurers and their policyholders. Now, last month, representatives from the U.S., specifically the Department of Treasury and the Fed and the National Association of Insurance Commissioners, attended a meeting of the International Association of Insurance Supervisors in Abu Dhabi. And during the meeting, the IAIS, sorry, there's lots of acronyms here. During the meeting, the IAIS agreed to enter a monitoring period for its global insurance capital standards, but did not formally adopt implementation. Significantly, Treasury registered their official opposition to the deal and making it clear that the ICS in its current form still does not work with a U.S. state-based system of insurance regulation that has served American consumers for nearly 2 centuries, while the Fed did not register any official opposition at the same time. The Treasury's position was heard loud and clear on the global stage, but there is much more work to be done, and my legislation to ensure any international deal must recognize our system will play an important role in this process. Vice Chair Quarles, as you indicated in your response to my letter last year, the one in July, going forward, is the Fed committed to opposing any international proposal, such as the ICS, that does not work with the state-based system of regulation and the policyholders that it serves?
Yes, we continue to believe that the international process has to work for the U.S. It can't be successful if it doesn't. As you know, the IIS doesn't have any ability to impose its decisions on the United States. So it really, if it doesn't work for the U.S., it won't be implemented here, and so it really can't be effective.
And so just to be clear, so that I don't have any lack of clarity leaving here, you do continue to oppose an ICS, anything that doesn't serve the state-based system of regulation. Just to be clear, you do continue to oppose it.
Yes, we believe that the international standard has to accommodate the U.S. system.
Thank you very much. Chairwoman, I yield back my time.
Thank you. The gentleman from Illinois, Mr. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you, all the panelists, for being here today. I want to address my first questions to the Federal Reserve and FDIC. Both the Federal Reserve and the FDIC approved the merger between BB&T and SunTrust on November 19th, but the Fed simultaneously issued a consent order against SunTrust for unfair and deceptive practices. SunTrust repaid $8.8 million in fees that they had charged customers for those misleading practices, but the practice of misleading consumers was not exactly out of character for either bank. SunTrust and BB&T ranked 3rd and 12th respectively in the most banking-related consumer complaints last year. Did the Fed and FDIC investigate those complaints in the process of reviewing the merger proposal?
And are you referring to I'm sorry, which customer database? I want to make sure I answer your question correctly.
Did you investigate those practices when they came forward with their merger proposal?
We looked at generally, so we are a primary regulator for BB&T at the FDIC, and we have extensively
Did you investigate those things?
If you can just repeat what's the database or the survey? I don't want to mislead you.
I didn't mention a database. I mentioned banking-related consumer complaints against those two entities.
To the extent that we get consumer complaints about our regulated entities, including BB&T, we do investigate.
So you did investigate those? Is that within the purview of what you do?
I would assume we did, because without the list and understanding, did these complaints come through the CBP
Governor
portal?
Quarles?
Yes, I mean, we certainly took into account consumer complaints and looked into them. We have to take the convenience and needs of the communities into account.
Okay. I think that poor consumer compliance records of banks seeking to merge should be a factor in whether big banks are allowed to get bigger. I don't want to reward bad behavior. If the Fed and FDIC are going to scrutinize the consumer protection implications of mergers, I think that the CFPB should be given a formal say in the bank merger review process. That's why I announced today that I'm introducing the Bank Merger Review Modernization Act, which strengthens the process for reviewing bank mergers and gives consumers a voice in whether they're approved. Governor Quarles, is it fair to say, in your experience with bank mergers is quite extensive? A 1997 article in the International Financial Law Review described your work at Davis Polk as follows, and I quote, "He advises domestic and foreign banks and bank holding companies on a broad variety of matters, including mergers and acquisitions. He has been active in advising bank holding companies and security firms in proposed business combinations, including the merger of Morgan Stanley with Dean Witter, discovered JP Morgan's investment in the American Century Mutual Fund Company, and Bank of America's purchase of Robertson Stephens," end of quote. You also worked on Deutsche Bank's acquisition of Bankers Trust and JP Morgan's merger with Chase Manhattan. This past weekend, the New York Times, as I think was mentioned previously, did a profile of you and noted that you have met 22 times with lawyers from your former employer, Davis Polk, since October of 2017. Is it possible for you to be a neutral arbiter when it comes to big bank mergers?
Well, as you note, you were quoting from something from 1997, which is almost a quarter of a century ago. It has been 20 years since I had anything to do with Davis Polk. I do think that I have a lot of expertise in the area, but
but I have no particular...
And you feel that you are a neutral arbiter?
Absolutely.
Is that a yes? Have prospective bank mergers been a topic of discussion during any of your meetings with Davis Polk?
Prospective bank mergers. I can't think of any, but if there were, it would be CSI, confidential supervisory information. But so maybe it's confidential supervisory information for me to say that I can't think of any, but I can't think of any.
Okay, thank you. My time is about up, so I yield back, Madam Chair.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is recognized for 5 minutes.
Thank you, Madam Chair, for holding this important hearing, and thank you to our panel for your contributions and your service. I want to start with Vice Chairman Quarles and Chairwoman McWilliams. I sent both the Federal Reserve and the FDIC a letter this week about the importance of establishing a regulatory framework that promotes investment opportunities in startups and small businesses. I know the Volcker regulators are considering revisions to the covered funds portion of the Volcker rule, and I just want to encourage you as part of that process to allow banks to sponsor or invest in long-term and or venture capital funds that I believe are an important source of funding for companies seeking to grow. As someone who previously ran a startup in Silicon Valley that's awash with private capital, I think it's important for companies that need capital but aren't located in capital-rich centers like that, especially states like mine and regions like mine in Northeast Ohio. I want them to have as many opportunities as humanly possible, and I think that vision is shared. And so I guess my first question to both of you would be, as you're looking through this, how do you think about the covered fund definition and the ability for banks to be able to provide this?
Well, we are looking at ways to try to ensure that we effect the purposes of the statute, but in a way that allows the greatest amount of financing for the real economy, as is consistent with the purposes of the statute. I think that there are amendments that we can make that will do that. They're under active discussion currently, and we'll propose them and get a lot of comment on them. So I don't want to prejudge where that's going. But the considerations that you're raising are considerations that they're on the table for us.
Ms. McWilliams, same answer, yes or no?
Likewise, and I can also tell you from my experience in Silicon Valley working with startups, that capital investment is crucial.
It's unbelievable,
especially in the earliest stages, and we're cognizant of the ability of small businesses to create opportunities in America.
And then back to Mr. Quarles. So with the SOFR transition that's coming under, does the Fed support an extension of LIBOR beyond 2021 for existing contracts? Not new ones, but for existing contracts that are already out there?
So the issue is, and there has been some confusion about it, is that it's not a question of the regulators prohibiting LIBOR beyond the end of 2021 for existing contracts, but the risk that it simply won't be available because the banks that participate in the production of LIBOR have indicated that they may be unwilling in order to continue participating.
But if it's available, would you support it?
That we'd have to consider what that meant, how it was being produced, how many banks had dropped out, how arbitrary was it then, given the remaining production process. But in connection with your question, the issue of how we handle the legacy contracts, the existing contracts, is a big one, and we are wrestling with an efficient way to do that ideally would not require the renegotiating of millions of contracts.
Yeah, I think that'd be chaotic, to put it lightly. And then one concern I also hear with SOFR is it could be pro-cyclical just due to the nature of SOFR itself. Do you believe in the creation of credit-sensitive overlays or to SOFR or an alternative rate with credit spreads?
I think that's a question that we ought to examine more than we have. I don't have a view ultimately as to whether that's something that ought to be there, but I do think that it deserves more examination than we've given it.
Thank you. And then with my final question, I want to focus on the repo market, which has been mentioned a little bit. I've heard, and I don't mean this as a criticism, but I'm just sharing my view. I've heard a lot of different explanations of kind of, yeah, it might be that, it might be this. We're not entirely sure. Do you have a sense that the Fed has a good grasp of what exactly has happened, what the driving factors are, and how we can correct it going forward?
I do think we have a good grasp on what the driving factors have been. I think that it's a complex question. I don't think that it's an easy answer to say this was the factor or here are the two factors. But I do think we have a good grasp on the various factors that contributed. And I think we have a good grasp on the measures to be taken to address them. And both the short-term measures and the longer-term measures, and all of them are under consideration at the Fed.
Thank you. And I guess with my final few seconds, I just encourage you to share that with us, because right now it feels like we're more in the dark than I think is appropriate given our role. Thank you, and I yield back.
Thank you. The gentleman from Texas, Mr. Green, who is also the chair for the Subcommittee on Oversight and Investigations, is recognized for 5 minutes.
Thank you, Madam Chair. I thank the witnesses for appearing as well. And I am pleased to announce that I have in my hands a statement from the CFPB. It is styled, Federal Regulators Issue Joint Statement on the Use of Alternative Data in Credit Underwriting. And the agencies would include the 3 that are here, and it includes 5 of the regulatory agencies. My assumption is that some considerable amount of thought went into this decision. Is that a fair statement when you issue a joint statement that considerable thought goes into it? If you agree, just raise your hand, please. Okay, sir, all agree. Let the record reflect that all agree. And my assumption is that you wouldn't make this statement unless you concluded it was absolutely something that could be of benefit to our economy, to consumers. Is that a fair statement? If so, would you kindly raise your hand? All seem to agree. I'd like to read the last sentence. In fact, I'll read just a portion of it. It's a rather long sentence, but I'd like to read a portion of the last sentence in the statement. It indicates that in doing this, might improve the speed and accuracy of credit decisions and may help firms evaluate credit worthiness of consumers who currently may not obtain credit in the mainstream credit system. Strong statement. So let's have our person who is representing NCUA. Could you give some indication, please, sir, as to how this will do what I have just read that you have published?
Yes, sir. We are really hoping to bring additional individuals into the mainstream economy by looking at alternative means of credit, such as how do they pay their bills, utility, cell phone payments. These are just other options that it's going to take to give individuals an opportunity to demonstrate their ability to repay. So in signing on to that, we really want to make sure that we're helping people who are low to moderate income. There are many folks that we find that are what we would call credit invisible. This is one of the many tools, and one of many I hope to come, that will again enhance financial access and services to people who've never been a part of the mainline economy.
Thank you. If you concur with what was just said, would you kindly raise your hand, please?
With a caveat, can I add the caveat?
With the caveat, all right.
The caveat is that we have 24.2 million underbanked households in the United States, and I believe it's 8.4 million who are unbanked. And a lot of these households are, frankly, first-generation immigrants with no credit history and people who live in low and moderate income areas, a lot of minorities. And for them, to the extent that they don't have credit established, according to the traditional understanding of credit underwriting criteria, we would like to be able to allow companies to extend credit to them based on their transactions, such as cell phone bill, utility bill, but our existing guidance in place made it questionable exactly how entities would engage in that type of extension of credit. So I believe this is an issue that has a broad economic impact, but also I believe it's an issue that's an equalizer for a number of people who have not been able to obtain traditional credit.
All right, if you agree with what was just said, would you kindly raise your hands, please? I assume you agree with your statement, so let the record reflect that all agree with the statement that was just made. Given that you all agree, and you seem to indicate that this will have some positive impact on the economy, Does anyone have any thought as to what this impact might be? This might be a question for the Fed. I'm not sure. You do a lot of paper work at the Fed wherein you analyze data. Do you have any thoughts, please, sir?
We do a lot of research, but I don't have that research at hand, but we'd be glad to provide you any work that we've done on the quantification of that.
In a broad sense, would you think that this could have a positive impact on the economy overall?
Absolutely.
Thank you very much. I bring this up because we passed a bill out of committee, H.R. 123, that addresses this additional credit scoring, alternative additional credit scoring. We had to go with alternative additional because of the confusion with alternative. Some people thinking that it might replace the traditional system. And I'm pleased that you have come to this conclusion, and I'm hopeful that we'll be able to get this bill to the floor. Thank you, and I'll yield back the balance of my time.
Thank you. The gentleman from Virginia, Mr. Rickleman, is recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you all for being here. I want to first echo the sentiments of my colleague, Mr. Barr, regarding the Hemp statement issued yesterday. I had some questions for you, Chair McWilliams, but I will follow up in writing because after hearing Ms. Presley's questions on FedNow, I want to spend my time focused on that issue.
Thank you.
Thank you, ma'am. Vice Chair, I'm not quite sure. That's a good thank you, though. Vice Chairman Quarles, you were the lone dissenter at the vote in August to proceed with the development of FedNow, and I understand why you voted that way at that time. I introduced a bill that would require the Fed to adhere to its own policy statement, including cost recovery. When will we know the cost, as far as you can tell, Vice Chairman Quarles?
Well, we obviously had estimates of the costs that were considered as part of the approval. We would necessarily need that because the ability to recover the costs is a statutory requirement. And we believe that we can recover the costs.
And do we know what that cost is right now?
I can't tell you off the top of my head, but we do have estimates of it.
Okay, thank you. I'd love to see that. And when do you expect that cost recovery will be achieved?
Well, it would only be over an extended period of time. I think the law requires 10 years, doesn't it? It's long-term, but it would be over a long period of time.
Long period of time. Thank you for that. And you know, I'll have more questions on that later, but you know, we have this 5-minute beautiful thing we have here. So on November 20th, the FAQ published by the Fed, your agency states, the board does not have plenary authority to regulate payments. What does that mean exactly?
So it means that we don't have direct regulatory authority. Among the concerns that were raised with the private sector system was that they could have discriminatory pricing, they could have pricing that disadvantaged some, and while they had said that they would not do that they would have one price for all, the Federal Reserve does not have the direct regulatory authority to address that if in fact they change their minds. That's what that meant.
Thank you. And as proposed by your agency, FedNow will be operational by 2024, give or take. Is that correct?
Give or take.
Give or take. Some of my colleagues have introduced legislation that would dramatically expedite that service despite the current operational and functional existence of a private market platform. If Congress arbitrarily, without understanding, required the Fed to move ahead of its own timeline, what would be the effects, particularly on consumers and markets, as we went forward with that?
I would be concerned about a significant acceleration just because of the difficulty of execution. It's a very, very big project. I'm not sure that the laws of physics would actually allow its acceleration very, very much from what has been proposed.
Yes, sir. And I love the law of physics. And we're looking at the proposed as far as the arbitrary timeline. You still think 2024 is a valid date for execution of FedNow?
Yeah, I think that's reasonable.
Reasonable. So, and here's the issues and why I'm asking these questions. On innovation, and my experience has taught me, and that's really been my background, is research and development or quick reaction capabilities, things of that nature in the Department of Defense. It's taught me if that you want to solidify a monopoly or a duopoly, then you should have the federal government get involved. And in the payment space, RTP is new, but it's likely not the ultimate or final development. So how do you see the Fed's involvement as potentially stifling innovation and even maybe hurting consumers as we go forward?
Well, I think that it will be a task that we'll have to ensure that it doesn't do that. As you've noted, innovation here is very rapid. And while I do have concerns, they ended up not being shared by my colleagues on the board, that that we would not be able to keep up with the innovation. The fact that the Federal Reserve was implementing something on the basis of current technology could in fact be outdated by the time that we were completed with it. That's a task that we will have to address. The Federal Reserve will devote resources to ensuring that we try to address that, and my colleagues were convinced that we could.
Yeah, and that's why I find it so interesting, Vice Chairman. We talked about the initial cost based on the report on what that would cost. Is there any costing on the sustainment cost of keeping up with technology after the initial implementation of FedNow?
With respect to all of that, we will be required to recover the costs under the law, and so as we would make amendments to that rapid payment system in the same way as we make additions or refinements or improvements to the current payment system that we provide, we will recover the costs of those investments.
Thank you so much, and thanks for your time.
Thank you. The gentleman from Florida, Mr. Lawson, is recognized for 5 minutes.
Thank you, Madam Chair, and welcome to the committee. I was happy to learn from your discussion about what the institution are doing to provide credit to those who are underbanked, which I think is very successful. Unfortunately, many people turn to alternative sources of borrowing, including payday loans, in order to get access to capital when they are turned away from banks, sometime including credit unions. Ms. Williams, can you talk more about the payday alternative loans and how this has helped bring more people into the banking sector?
I believe there's an opportunity for banks to engage more in a small dollar lending space. As was mentioned previously, there's a Federal Reserve study that says that a large percentage of the population, about 40%, do not have $400 every month for emergencies. And unfortunately, we don't have a lot of banks in the small dollar space, and the consumers are now going to alternative channels for those products. We have ample consumer protection laws at the banks and the bank regulatory agencies, and frankly, I would like to see some of those products return to banks where we can make sure that the consumers are protected. I also think that there is a lot of dichotomy in the federal regulatory framework with respect to small dollar loans. You have from the FDIC, there is a 2013 guidance, there is a bulletin from the OCC 2017, there are supervisory letters from the Federal Reserve, there is a rulemaking at the CFPB, and they're not all quite frankly synchronized. And I think there's an opportunity for us to synchronize these rules to make sure that consumers who need small dollar credit and are in dire need of responsible small dollar credit can do so through banks, which we regulate.
Okay. Thank you. Mr. Hood, I have probably been a member of credit unions some 40 years, I guess, when I first started off. In the area that I'm in the capital city, there's a lot of credit unions and some small bank, but there's been more concern since I've been up here in Congress from some of the smaller banks about the growth of credit unions, and I know that when you're in a government town, university town, and so forth, where I am, you don't really think about that because people want to have access to capital. Do you feel that the concern from the smaller banks is going to continue to cause more regulation put on credit unions?
Well, I think that the important thing is that their banks and credit unions are all competing in today's dynamic marketplace, where at the end of the day, it's the end user, whether it's a credit union member or a bank customer, they're getting access to regulated, affordable financial services. I'd much rather have banks and credit unions continuing to grow in today's economy, because we know what happens if that doesn't occur. Then it leaves all of these communities that are underserved vulnerable to pernicious payday lenders. So I don't want to pit banks versus credit unions. I want to say in the credit unions, they are growing. The credit unions because of members wanting to have institutions that they can get affordable capital. So when I made my opening statements this morning, credit unions now serve a third of the American public. And I think that is because of their commitment to providing access.
And that's a very good answer. And my next question would be, before my time run out, credit union now takes members all over. You know, should there be any limitation on the memberships outside of the institutions that they are formulated on?
That is an area that first of all, we do have field of membership restrictions. No matter which credit union one joins, almost everyone in this room can join a credit union, but just not the same one because of those field of membership restrictions. So if there's a particular question you have in mind, I'd be happy to sit down with you, but no. The credit union's models were based on, for instance, you would have a plant or you would have a company. Now, as credit unions, and sometimes those instances, companies have left markets, well, then those credit unions will apply for a community charter and things of that nature. So at the end of the day, credit unions still are governed by membership restrictions.
Should you be kept at a certain limit of the number of memberships that you could have?
I think, sir, that is a free market decision. I think that is up to the credit union and the member of that credit union. But again, as long as that member has the field of membership restrictions in mind, then I, as regulator, I can't impose that. I can only ensure the safety and soundness of the credit union system and the share insurance fund that guarantees the deposits.
But after you go to a certain level, the tax implication or the tax exemption that you have, how did that affect you?
Oh, you were talking about the tax exempt status of the credit unions in terms of their size. Well, sir, I, again, am looking at the safety and soundness. Regardless of whether you're a $1 million credit union or $100 billion credit union, it is up to Congress to determine whether or not credit unions maintain their tax-exempt status.
Okay, with that, I yield back.
Thank you. The gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Mr. Quarles, I really appreciate you being here. As you and I have talked about many times over the past couple of years, CCAR is really important to me in ensuring that we revise and become more transparent with some of the stress capital buffer rules is really important to me as well. And I was delighted to hear earlier today, I think in response to Ms. Wagner's question, you say that you're still aiming to have that done in time for next year's stress test cycle. I wondered if you would start kind of day zero today, how we get there, because you alluded to, I think in your answer to her question as well, about how challenging the timeline might be to do so, but still felt like it was reasonable. Can you kind of walk us through what's the comment period look like? How long does it take to distill that into a rule? How long does it take to get that rule out so that there's some transparency in it beforehand, given these large institutions are relying a lot on that test and some of their capital planning thereafter? We want to make sure that they get adequate time beforehand to understand what that test looked like.
Well, in order for it to be effective, at least for the next cycle, at least some elements of it would have to go final as opposed to be reproposed.
Correct.
And we have the ability to do that on the basis of the comments we've received for the proposal that's out there currently. Over the course of the next several weeks, we can do that. We haven't determined if that is the right approach, which is why I say we can do it, and it's still our aim to do it, but we haven't finally decided if that's
when do you
how we're
expect?
going to approach
Yeah,
it.
when do you expect to make that decision? I guess what I'm looking for is when can I follow up? When can other members of the committee? When can those that have a significant stake in this? When can we follow up and say, okay, this was the next point at which we expected a decision, next point at which we would expect a step taken by the Fed in order to reach that outcome by that date certain? When's the next step we could expect that we could follow up and find out whether that step was taken?
Well, whether we go final will be clear at the time we go final. I think we have about another month if we were to take that view.
Okay. And the decision would have to be made before then, obviously, in order to lay that out. Right? Okay. So it would be reasonable if we followed up in the next couple of weeks to ask whether a decision was made to go forward with that and whether steps are in place to be able to go forward with that. I just believe that this is a really important aspect of what I hear from large institutions today. More transparency in this process, more clarity in this process so that they can plan long-term with their own capital. And hopefully that continues to support the economy overall. So I appreciate that answer. Mr. Hood, you and I had a great conversation a couple weeks ago as we talked about, I've had some institutions that have come into the office concerned about a recent trend of credit unions purchasing smaller banks, right? But at the same time, I've had some great Hoosiers that have come into the office and said, were it not for that acquisition of a bank by a credit union, my local branch probably wouldn't be here, right? That community wouldn't be served by that. And I felt like, frankly, you really articulated so well in that call how you think about this, how you approach this, right? And the rubric by which you're discerning those. I wonder in a minute and a half whether you might give us all a preview and a review of how you think about this.
Yes, sir. Thank you for the question, and thank you for our recent meeting. Yes, to date, there have been 32 credit unions that have acquired bank assets, 32 over the past 7 years, or actually since 2013, whereas there have been roughly 250 bank-on-bank acquisitions just over the past year alone. I'd like to note for the record that these are voluntary, market-based transactions. At the end of the day, it is the FDIC and the NCUA who must approve these transactions. In approving those transactions, we at NCUA are going to look to ensure that the bank is going to have the members that could qualify for the field of membership. We're also going to ensure that other statutes of the Federal Credit Union Act are implemented, such as the fact that business lending is capped at 12.25% of assets, and also credit unions are not allowed to have anything other than retained earnings for their capital. The credit unions are not going to be able to have any of the stock that an acquiring institution would have had. Also, I'd like to note that in many of these areas, as you noted in your introduction, if it weren't for credit unions acquiring some of these banks, the community would be left without a financial institution. It would leave them vulnerable to, again, pernicious payday lenders. I also would like to note that at the end of the day, the bank does get to choose or select who that acquiring entity is. And again, let's note, dual approval, both FDIC and NCUA does approve these, and they're not happening arbitrarily and capriciously.
Right. I think that's important to remember, and I really appreciate that. I knew your comments would help give some comfort to those that think this is happening in the absence of oversight. So I really appreciate your thoughtfulness about that.
And we've had a bank that has acquired a credit union.
Right, fair enough. And I'll follow up with you, Mr. Quarles, as well. Thank you so much for your time.
Thank you. The gentleman from Utah, Mr. McAdams, is recognized for 5 minutes.
Thank you, Chair Waters, and thank you to our witnesses for being here today. Chair McWilliams, previously when you testified before this committee, I asked about whether the FDIC had the authority needed to properly regulate and oversee ILCs. And you testified that you believe that the FDIC did indeed have all the authority it needed to regulate ILCs and to ensure that they operate in a safe and sound manner. Do you still agree with that statement?
I do. I believe that Congress gave us ample authority to supervise the ILCs, yes.
Thank you. And you also stated that you would not approve an ILC application for deposit insurance if you believed that it would put the insurance fund or the financial system at risk. Since that time, the topic of ILCs has gotten a lot of press and legislative attention, with some calling to effectively end the ILC charter as we know it. Some of what I hear in support of ending the ILC charter is that ILCs are unregulated and pose a significant risk to the U.S. financial system. I would like to say that I strongly disagree with both of those points, and I would like to use a bit of my time to follow up on them. My state is home to many ILCs, and in our experience, these institutions have proven to be remarkably safe and well-regulated. First, in regards to the claim of ILCs being unregulated because their parent companies are not subject to the Bank Holding Company Act, isn't it correct that the FDIC has authority to regulate the relationship and transactions between the parent company and the ILC to ensure that the ILC and our financial system remain safe?
In fact, we're actually able to require the so-called CALMA agreements, which is an agreement that provides for minimal capital and liquidity standards that the parent would be obligated to bestow upon the ILC to ensure that the ILC is safe and sound.
Right, and I would also add that the FDIC has authority to issue cease and desist orders. The bank-centric model requires the bank to have an independent board and management. Section 23A and 23B sets terms around the transactions, et cetera. Do all of these provide the FDIC with adequate authority over those relationships and transactions in your view?
So on Section 22 and 23, I would have to defer to the Fed, but Congress gave us ample authority to regulate the ILCs, and I certainly have staff I'm paying to regulate the ILCs, so if we're not regulating them adequately, I think some people are getting a lot of money for not doing their job, but that's not the case. We have a lot of experience regulating the ILCs, and unless Congress decides that to treat ILCs, otherwise we will continue under the existing congressional authorities.
Thank you. And second, regarding the risk posed by ILCs to the U.S. financial system, for decades, ILCs have proven to be some of the safest and most stable banks in the nation. Can you tell me how ILCs compare to most other banks in the capital that they hold and in their failure rates over the past 30 years?
They're generally better capitalized than banks, and we don't have that many ILCs, frankly, so it's a limited universe of entities we're talking about. They're well capitalized. It is our experience that they're generally well managed. Again, it depends on an institution by institution basis, but we have not experienced issues with the ILCs.
Thank you. That's my understanding as well. Moving to a different topic, I want to discuss CRA. And with respect to the Community Reinvestment Act, more of a statement than a question. I've spoken with you all previously about the need to preserve the spirit and the intent of the CRA to benefit low and middle income communities and individuals while also updating the CRA for a 21st century financial system. I understand that the OCC and the FDIC may be moving forward on a proposal without current buy-in from the Fed. And I do have concerns about this not being a unified rulemaking. It's one thing for financial institutions to comply with the CRA regulations, but CRA also involves numerous community partners, as I know as a former mayor myself, many of which don't have the resources or time to understand potentially conflicting CRA regulations. So I would urge all of the agencies to come together on a single proposal that strengthens and modernizes CRA. And additionally, I share many of the concerns that my colleagues have expressed with respect to CECL and the impact that it may have on credit availability, in addition to the compliance requirements for financial institutions. Moving on to another topic, Vice Chair Quarles, the Federal Reserve has been contemplating, as my colleague Mr. Hollingsworth raised, the stress capital buffer for some time now, with the proposal released in 2018, more than a year and a half ago. Ensuring that we have rigorous stress tests and appropriate capital levels is important. So I just want to reiterate that I share my colleague Mr. Hollingsworth's concern and goals about achieving this and having this completed by 2020. And lastly, Mr. Quarles, it looks like I'm about out of time. So I would yield back. I may have some additional questions for the record, including on the agency's future work on covered funds and fund structures. So thank you, and I yield back.
Thank you. The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
Thank you. Chairwoman McWilliams, you told Mr. Lawson, my colleague, that you want to return small dollar lending to banks. Were you referring to the FDIC's looking the other way when FDIC supervised banks are helping predatory lenders charge up to 160% in 26 states and the District of Columbia where that rate is illegal?
No.
Are you aware of this practice?
I'm aware of some examples of the interest rates that you cited.
Are you aware that FDIC banks that you supervise are engaged in rent-to-charter, rent-to-bank schemes that are allowing predatory lenders to make loans with those interest rates in states that have chosen through the democratic process to prohibit those rates?
I'm aware of partnerships that banks have created with entities that are offering those loans, and I'm also aware of the enforcement action that we engage at specifically to institutions that do so in a manner that's not consistent with the consumer protection or federal laws.
What is consistent with consumer protection about lending at a rate that is prohibited under state law?
So the rates are set by state law. Where we look at consumer protection, as you all know, is are there issues with fair lending practices? Are there issues with unfair and deceptive acts and practices?
Pardon me, Chairwoman, I think I didn't make myself clear. Today, FinWise Bank and Republic Bank are engaged in partnerships with entities like OpLoans and Rise/Elevate, and what they are doing is making loans at rates like 160% APR in states that have banned that rate. How is it consistent with FDIC's supervision of consumer protection rules to allow these state-chartered FDIC-supervised institutions to engage in these partnerships that evade state law, democratically passed state law regulations on interest rates?
We don't regulate state interest rate caps or what's permissible or usury under state law. But I can only say this because it's a public, we did have an enforcement action against one of the entities you mentioned. It's a public enforcement action. You can find it on our website, where we thought that their consumer compliance record was not, frankly, of the expectations and qualities we have of our supervised entities.
And so are you aware of statements made on earnings calls by lenders in California in the wake of California's new lending law. Several payday lenders announced on their earnings calls that they plan to use rent-a-bank schemes to evade California's new law that outlaws 100 to 200% installment loans.
I'm not, and I frankly don't listen to payday lenders' investor calls. I just don't have the time. I can tell you this, that states actually have an opportunity to opt out of the ability of out-of-state entities to provide interest rates that are prohibited in that state. And that's up to states to decide. Congress gave the states that authority, and it's frankly implemented in Section 27A of the FDIC Act.
Okay, thank you. I wanted to turn to follow up on what my colleague, Mr. McAdams, was asking about with regard to the Community Reinvestment Act. I'm confused. I read the statement of Mr. Otting on November 20th when he announced that the Fed is not going to participate in the CRA modernization effort. I then read the statement of the Federal Reserve spokesperson. I am confused. Who here, and just feel free to raise your hand, who here is the good guy? Okay, now you understand that you two are on different sides of this. So I am concerned that I am pretty knowledgeable about the CRA, and I can't tell which one of you is in favor of which proposal. I share what Mr. McAdams said about why is this coming unraveled. I'm very concerned that it isn't a joint rulemaking, but I can't even tell which of you I should be sending a letter to complain. And I think this obfuscation is really unhelpful to the American people who need to be engaged in this CRA process. Mr. Quarles?
I think it's inaccurate to say that we are on opposite sides. We have been pursuing a joint rulemaking, and we will continue to pursue, the objective will continue to be, at the end of the day, we will have a final joint rule among the three agencies.
Okay, but I'm not mistaken that Comptroller Otting, who's not here today, of course, announced that the Fed will not participate in the CRA modernization. Are you contradicting that?
Fortunately, my time is up.
You yield back the balance of your time.
Oh, there is time, right?
There is
no,
time.
there isn't actually. She's over. 19 over.
We have indicated that you may answer questions in writing and send your responses to any of our members who have not had the opportunity to have them answered today. I'd like to thank our distinguished witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.